Hi everyone, good morning. Very sorry again for the slightly delayed start this morning. We have had one or two technical issues this morning, hence our delay. Um, Normally at this point I do a bit of an introduction. I think I'm probably going to skip that this morning in the interest of time. Um, I don't know whether you might be able to see a potentially blank box on the screen that perhaps is next to me called Kevin. Um, Kevin has some video challenges this morning, I think. Um, I think we're just going to have to get underway. You possibly won't be able to see Kevin. We can see his screen. He can see your Q&A. Just a few pieces of housekeeping before I hand over. So, we are recording today. You probably will have seen that as you join the webinar. We'll post the recording on the K3 Hub website later today. Q&A function is open. Do feel free to ask questions as we go along. Preference is if you could use Q&A rather than the chat for your questions so that Kevin's got everything in one place so he knows where to go. We are going to post a PDF of the slides into the chat shortly, and then we'll do that periodically throughout the session. Excuse me, throughout the session for any latecomers. We do know that today's quite a long session, so we are going to take two breaks. They will be on or around the hour. Anyway, I'm going to move on and introduce you to Kevin. Kevin Reed is new to us here at K3 Hub. Kevin is a chartered accountant. He's a freelance lecturer and a writer of technical material. He's ex-Big Four and has been running his own consultancy, offering training courses for professional advisors on a range of tax topics since 1992. He regularly delivers updates to local societies of the ICAW and ACCA conference. Today, his session will include scope of IHT following the Finance Act 2025 reforms, revision of basic IHT rules, Finance Act 2026 IHT changes to unused pension funds, succession planning in family businesses, and the treatment of CGT upon divorce. Just before I go, a quick plug for a couple of forthcoming CPDs. On the 19th of June, we have corporate tax update, and 3rd of July, which I think is our last CPD before we have a short summer break, on how AI can supercharge your finance team. Invitations come out on a regular basis, so do keep your eye on the inbox. We also promote the events on the K3 Hub website and on LinkedIn. As a side note, do feel free to connect with me on LinkedIn. I share all of K3 Hub's posts, and so you can catch up with what we're up to there as well. I'm going to hand over to Kevin now, and apologies for the technical problems. I see a couple of people are suggesting we have echo on the sound. I'm not sure why that is. I'm going to hang around in the background. We'll get underway, and let's see how we fare.
Okay, thank you, Marie. Good morning, everybody. Again, sorry for the delayed start. I think it'll be the first online webinar I've ever done where I think people can't actually see me, so apologies for that. But as long as you can see my slides and hear me, you'll obviously be able to follow things. We're starting about 10 minutes late, so I won't cut you short. We'll sort of run till about 10 past 12 to make sure you get your full time. Um, I'll quickly run through. I know Marie listed a few topics there, but I will quickly run through what we're going to cover. My understanding is a majority of you, I know not all of you, tend to work for smaller firms, and my years of experience in teaching, I know that most smaller firm people don't tend to do that much inheritance tax. I know there are exceptions. I'm not trying to say everyone is the same, so what I'm going to be doing in the first hour or so is really reminding you about a lot of sort of basics of inheritance tax, which you need to know about and understand in order to understand some of the more planning oriented areas. So I'm just going to very quickly, it'll take a couple of minutes, talk about the overall scope of IHT, and then on the revision of the basics, we'll remind you quickly about potentially exempt transfers and chargeable lifetime transfers. Remind you all the exemptions there are that you can make use of in IHT, including for spouses and for lifetime gifts. And we'll move on and look at within that. We'll remind you about the different types of trusts there are as well, because that's fundamental to dealing with IHT planning. And then we'll move on a bit later to transferable nil rate band. remind you of the basics of it and what the implications are in will trusts. We'll also mention the residence nil rate band, which in its detail is one of the most complicated things I ever have to deal with in tax training, believe it or not. But we'll let you know the key bits, and I'll do an example that will show you that you have to be very careful with it. Um, then we'll get on to business property relief. I'm not going to cover agricultural property relief today. I don't know if any of you deal with farming businesses, but I have put a section at the back of the slides as an appendix that you can review yourself. And we'll look at the impact of the new limits from the 6th of April last year for 100% relief. And we'll have some discussion about what constitutes relevant business property, which you need in order to be able to get business property relief. And we'll look at some particular problem areas like property businesses, when you've got trading businesses, but they're holding a lot of cash, some bits to do with LLP and partnership structures. And then I think probably the most important of all the areas today for you will be the coming changes to IHT and pension funds, because it's going to have quite a big impact for a lot of people, potentially with very high, producing very high marginal rates of tax on pension funds that are unused at death, and also it greatly increasing the complexity of admin for estates as well. And part of that's caused by the interaction with the income tax rules that there are for pensions. So we'll have a look at that, and I've got quite a big example to do for you. And then the latter part of the session, we'll get on to looking at succession planning in family businesses more generally, about spreading shares around a family, CGT tips and traps, using trusts to reduce CGT, and a short session about what I'd call simple pre-death IHT planning. When you suddenly find you haven't got long to live, in the context of family companies. I don't know if I'll get time to get onto it, but I've also added in a bit of PPR because the rules changed in Finance Act 2023 on divorce or separation. If I don't get on to cover it in the lecture, you'll have it there in the slides. So, despite the technical issue, I hope you'll find it useful. Do put your questions in the Q&A, and if I can cover them, I will do. But I have got a lot to get through, so I'm only going to review the Q&A very occasionally, and probably have a look at the end as well. Okay. So the scope of inheritance tax. If you know much about inheritance tax, you'll know that historically your domicile status was the key. If you were a UK domiciled person, had the UK broadly as your country of natural home, your worldwide assets came within the scope. Whereas if you were a non-domiciled person, it was just your UK assets. That has now changed following the major reforms last year. And for inheritance tax now, the distinction isn't in your domicile status, it's whether you're a long-term resident or not in the UK. And if you're a UK long-term resident, your worldwide assets are within the scope. And if you're not a long-term resident, then it's only your UK assets. So you obviously need to know how a long-term resident is defined. And it's someone who has been UK resident for at least 10 of the previous 20 years. And that's all based on the statutory residence test. If you're someone under the age of 20, they vary that so that it's someone who's been resident for more than half of their life. And the new provisions for a non-resident individual who's left, sorry, I should say, going too quickly there. Obviously, people might be a long-term resident and within scope and then become non-resident. And if they become non-resident, then how long do they stay within the net? Otherwise, anyone, if they found they didn't have long to live, could just emigrate and die 6 months later as a non-resident. So the new provisions that we call the tail provisions for when a non-resident individual who has left the UK, having been a long-term resident, the number of years that their non-UK assets will stay within the scope of IHT will depend on how long they've been resident prior to departure. So if they were resident for 13 years or less, they'll stay within scope on their worldwide assets for another 3 years. And then you add an additional year for every extra year that they were UK resident. For example, someone who was resident for 17 years would remain within the scope for 7 years. And you won't be a long-term resident if you were non-UK resident for any 10 consecutive tax years during the 19 years before the current year and are currently not UK resident. That would mean you'd have fallen out of the net. And basically, in summary for you, how that looks is like that that's the number of years your worldwide assets stay within the scope. So if people are thinking of emigrating who've been living here, clearly that's relevant for them. And the other thing is that if someone is coming to the UK, initially their worldwide assets are not going to be within the scope, but once they become a long-term resident, they will do. So that's something that needs discussing with clients as well. Okay, so that's just an overview of how IHT hits these days. Next thing I'm going to talk about for 5 minutes or so is the main types of trust. So I know not all of you will be terribly familiar with dealing with them, and I always find that the problems people have with understanding inheritance tax rules with trusts are often because they don't really understand what the trust is doing in the first place. So, not just the inheritance tax rules, indeed, the other tax rules for trusts as well. So, the first one we've got is an interest in possession trust. If any of you are listening in Scotland, that's called a life rent trust where you are, and you have an interest in possession if a beneficiary has an immediate right to either the trust income, so if the shares in the trust, the dividends are automatically going to go to them, or the use rent free of the trust property. So giving someone the right to live in a property rent free creates an interest in possession for them. Also call it a life interest, although the interest in possession doesn't have to be for life. It can be for a particular period, like for 10 years or until your ex-spouse remarries or something like that. A quick example, Sylvia puts assets into trust for Lou, who's to receive the income for life. And the technical terminology that you should familiarize yourself with trusts is anyone who creates a trust or a settlement, you can use the term synonymously, is called the settlor. And Lou is called the life tenant of the trust, and he's the person who's got the right to receive the income. And we refer to him as a person with an interest in possession. And he's also called the income beneficiary of the trust. And then on Lou's death, the capital is to pass to Ros absolutely. And we call Ros the remainder man of the trust. It's one of the few areas we don't really seem to have developed non-sexist terminology. You can refer to her as the remainder woman or remainder person if you want, but Ros would be the remainder man of the trust. And she's said to have a reversionary interest in the trust property, i.e. the trust property is going to revert to her at a later date. And she's also referred to as the capital beneficiary of the trust. In Scotland, remember it's called a life rent trust, the life tenant is called the life renter, and the remainder man has a completely different name, the fear. Other than that, everything works the same way. And you need to sort of understand why people might use these sort of trusts if you're looking to be planning for your family. So imagine you're Sylvia, or put it another way, if you are Sylvia, who might Lou and Ros be in relation to you? Why have you done that with your wealth rather than making outright gifts? Now, with some of the technical problems that we've had in terms of, I won't sort of try and get a particular response from you, but typically Sylvia, for instance, might be someone who's now married to Lou, that has a daughter from a first relationship, and she doesn't want a lot of assets to pass to Lou because she knows that despite her best efforts, him and her daughter don't get on at all. She's happy to leave him income to live off, but she wants her assets to go to her daughter. Or it could be grandmother, son, and granddaughter, where the son unfortunately has a gambling problem and she doesn't want to leave a load of assets outright to him, knowing that he'll waste them and they won't get to her granddaughter. But she's happy for him to have some income to live off. She doesn't worry if he wastes that, but the capital is going to pass to the granddaughter. So you usually use interest in possession trusts to ensure succession of capital onto a third person. And nothing to do with tax there. You've got to make sure the trust is doing what you want and then consider the tax side of it. And you should also be aware that within any interest in possession trust, I don't think you get a solicitor to draw one up without putting a power of appointment in it, often referred to as an overriding power of appointment or a flexible power of appointment. And basically what that says is that the trustees have the power to override the general terms of the trust if they think it appropriate. For a sort of situation where they might do that is if it's income to Lou for life and capital to Ros. It could be that Ros, unfortunately, in her 20s, gets a very nasty disease like multiple sclerosis or something, where she might need some money now and she might not survive, long enough to eventually inherit the capital. And having a power of appointment in it allows the trustees, if they think it appropriate, to override the general terms of the trust. So those are the key things to be aware of on an interest in possession trust. On a I've obviously mentioned the typical use of it there, power of appointment. For a discretionary trust, which is the other main type, there is no interest in possession in it. And the beneficiaries or a class of beneficiaries will be known. So you don't have to identify the beneficiaries by name. It could be, for instance, for my grandchildren. And that means even after the trust has been created or after the settlor has died, if more grandchildren are born, they automatically become beneficiaries of the trust. But what the settlor is then doing is leaving it up to the trustees to determine who will receive income or capital when, subject to some overriding term there'll be in the trust deed that an age at which people should receive capital, but they can make distributions earlier if they want to. And a typical example, Steve puts assets into trust for his children, Bill and Ben. And the elder is going to be entitled to one half of the capital when he attains the age of, say, 35, and the younger the balance of the capital when he reaches the same age. And until then, and just say that 35 I put there as a completely random year. I could have put 25, 30, 47, whatever the settlor wanted to put in it. And until then, all distributions of income and capital are purely at the discretion of the trustees. Now, Steve is called the settlor of the trust. Anyone who creates the settlement is called the settlor. And Bill and Bernard are just called the beneficiaries. They, in the interest in possession trust, both Lou and Ros were beneficiaries, but they had such distinct rights that we gave them special names, the life tenant and remainder man. Bill and Bernard are just beneficiaries. And if I ask you the same sort of question as I did on the previous one, imagine you're Steve. Why are you doing that with your wealth rather than making outright gifts to the two children? Well, the answer is that if they might be, say, 18 and 19, and if Steve's wealthy and he gets hit by a bus and they both inherit 5 million quid each, there could be a lot of parties in the neighbourhood. One of them might already have a drug problem, and if he's suddenly got a lot of money, do himself a lot of damage. So you tend to use discretionary trusts really for two reasons. One is to stop people inheriting at too young an age, but but they can receive things earlier. If the trustees think it's for appropriate purposes, they can make distributions to them. The other reason is something like if you're putting family company shares into a discretionary trust. If you've got 3 or 4 kids and 8 grandchildren, you might eventually want those who are more involved in the business to have most of the shares in it, and it allows decisions like that to be delayed, perhaps even until after you've died, by having the shares in trust, so that at different stages they can be appointed out to people as the trustees think appropriate. So that's sort of reasons that you'd set up a discretionary trust, and we'll obviously get onto the tax of them soon. And just mention as well that with a discretionary trust, there'll be a separate document, often sort of stapled to the trust deed, which is called a letter of wishes, which, as the name implies, it is the settlor saying, well, here's the trust deed and these are the terms of it, but these are the sort of situations in which I would envisage you making distributions. And typically it can be for things like education costs, helping to buy a property, medical needs, but it can be absolutely anything. And the settlor wishes, and it doesn't it doesn't have to be good purposes, if you like. And the trustees, it's not legally binding, but they would normally try and go along with a letter of wishes. So those are the two main types of trust. I'm just going to very quickly mention a bare trust as well. Bare trust is a much simpler arrangement. It's basically a nominee arrangement where someone holds property unconditionally for a beneficiary. And we actually never use the term bare settlement, really. We always talk about a bare trust. And the trustee's only duties are to carry out the beneficiary's instructions and to transfer the property when so requested. And typically, you'll get bare trust set up for minors. If someone dies and they've got a young teenage child and they want them to inherit their property, legally the child can't own it until they reach 18, for example, and therefore it would be held on a bare trust for them. And whenever a bare trust is created, it's treated not like for tax, not like a trust arrangement at all. We don't have special rules really. It's treated as if the settlor has transferred it direct to the beneficiary at that stage for both capital gains tax and inheritance tax. And when the trustee eventually transfers it on to the beneficiary, that's ignored for tax purposes. It's already been transferred as far as tax is concerned. And there's no discretion about what the trustee can do. Basically, they've just got to hold it and transfer it on. They're technically not settlements, which is good news is most anti-avoidance doesn't apply to them. But there is one bit of anti-avoidance to be aware of on a bare trust, and that is if you set one up for a minor child, it's covered by the general rule in section 629 of ITOIA for parental dispositions, where if a parent creates a source of income for a minor child, that income gets taxed on the parent unless it's below a de minimis £100 a year from all such sources. So you may be familiar with that from your general tax knowledge. If you're not, I'll say it again, that if any parent creates any source of income, doesn't have to be via a trust for a minor child, any income arising on it is assessed on the parent unless it's below a de minimis £100 per annum from all such sources. And the other thing with a bare trust for a minor is that you cannot say it's going on bare trust until the child reaches 25, for example. Once they have the legal right to take it, they can take it, which is 18. So that's a sort of disadvantage for using a bare trust for a minor. Okay, I know I've gone through it reasonably quickly, but I hope that's given you an idea of what these trusts are, because we'll obviously be referring to them at different stages of the day. I will come back to trusts in a little while and explain the IHT rules on them. But let's look at something a little bit more straightforward first, and something that you perhaps might have more familiarity with, which is the IHT rules on gifts to individuals. So the different situations we have, if you make a gift to an individual, it could be a friend or a child or a grandchild, anything like that, the term for it is a potentially exempt transfer. And that means there's no IHT charge when the gift is actually made, and it only becomes chargeable if the donor dies within 7 years. If the donor survives 7 years, then it becomes completely exempt. Now, the rate of tax that's chargeable if the donor does die will be 40% above whatever their available nil rate band was, always 40% for death tax. Currently, the nil rate band is 325k if there are no earlier chargeable gifts, and we're going to talk a bit about that a little bit later. Any unused nil rate band, any nil rate band that's used against the lifetime gifts won't be available against the estate. But a sort of misconception that a lot of people have is that someone dies owning assets and any gifts they've made in the last 7 years just get all aggregated in. That doesn't happen. It works chronologically, that the lifetime gifts that have become chargeable are taxed first and get first use of nil rate band and the sort of exemptions that we're going to talk about as well. Now, it's obviously a bit of a big cutoff that if you survive exactly 7 years, there's no IHT. If you die after 6 years, 365 days, 364 days, there's a 40% charge. So we have something called taper relief, which, if there is a tax liability, reduces it. If you survive between 3 and 7 years, it goes down in annual stages. And what you do is you calculate the tax on that gift and then you taper the tax liability. So if you survive between 3 and 4 years, it's only 80% of that tax liability that's due, through to if you survive 6 to 7 years, it's 20% that's due. So that's how gifts to individuals are taxed, not to spouses. We'll talk about those separately, but other individuals. Another thing you need to be aware of, particularly in the sort of family context, is who pays the tax and when. Because if tax does arise on a lifetime gift like that, a potentially exempt transfer, it is the liability of the recipient of the gift. They have the primary liability for it. And the recipient, if you receive a gift, you could take out life insurance to cover the deceased, to cover the donor's life in case they died. Obviously, that would be subject to normal insurance risk as to what the premiums would be based on their likely life expectancy. The executors have to include the details of all relevant lifetime gifts on the probate forms, because obviously if they might be using up nil rate band, which would otherwise be available to the estate. And in fact, if there is tax on a lifetime gift and for some reason the revenue can't collect it from the person who received the gift because they've disappeared, say, then they can go after the executors for it and it would be paid out of the estate. It is possible to write a term into your will that all people who've receiving assets will share their proportionate share of the tax, and you can, I think, add in lifetime transfers to that. But if you haven't got such a term, then it would be chronologically, as I said, it is how it would work, and it would be the recipient of the gift that was primarily liable. And the due date is 6 months from the end of the month of death is when it would be due, to avoid interest. So those are the key things about who pays the tax and when. Now, the main lifetime gift exemptions are, first of all, gifts in consideration of marriage. If you've got a child getting married, as a parent, you can give them £5,000. This, both parents could, and even if the parent died within 7 years, that would be fully exempt. If it's a grandparent, it's 2.5K, and anyone else, uncle, aunt, godfather, anything like that, it's £1,000. Remember, these exemptions are only relevant if the donor actually dies within 7 years. Otherwise, it would just be a pet that became fully exempt. There's an annual exemption, which is £3,000 per tax year. And if you have more than one gift, it's allocated chronologically to the gifts in the year. And you can carry forward any unused annual exemption 1 year, but 1 year only. So if you didn't make any gifts last year, you could make £6,000 worth of gifts and have them covered by annual exemption should you die within 7 years. But if you have got a brought forward annual exemption, you have to use the current year annual exemption before you use the last year's brought forward amount. And then there's also a small gifts exemption, which works very differently. This is an amount per donee per annum. It's only 250 quid, and it's a de minimis type exemption. So if you make a gift above that, this exemption is irrelevant. Now, I think, the first cohort that ever had to learn about inheritance tax for their tax exams when it first came in back in the mid-80s. And all of those exemptions I've got on the screen there were exactly the same. They've been unchanged for what's now 40 years. And regularly there are, talk about whether everything ought to be reviewed and updated, but they've never changed those. So if you think they're pretty small, I don't blame you. Now, one type of gift I want to particularly emphasize to you, which can potentially save you a lot of tax in the long run, is there's an exemption for regular gifts made out of surplus income. And it's in section 21 of the Inheritance Tax Act. And to use it, what you've got to show is that what you were transferring effectively became part of your normal expenditure because it was regular. Secondly, that taking 1 year on another, it was made out of income, has to be shown to be coming out of income. And thirdly, it's got to be shown not to be reducing your normal standard of living that the person would wish to maintain. And that obviously can vary from person to person, be a question of fact. But if you are someone who has got more than enough income to live off, and for instance, you've got plenty of pension income coming into you as well that you don't particularly need, you can commit to passing that on regularly. And if you die within 7 years of making those gifts, they will not be chargeable to inheritance tax because they're covered by this exemption. They're treated as gifts of income rather than capital. Now, a bit more on it. You have to show that you can satisfy all of those three conditions. And one thing I mentioned I haven't put on the slides, but those who are familiar with life assurance bonds, you'll know that there's a 5% withdrawal facility, which gives you sort of effective income like spending power. And sometimes people have got life assurance bonds and they draw down on them, that 5% of original cost per annum, and pass it on to their kids because they don't really need it, thinking it's going to be covered by this exemption. It's not, because it's capital. What you're doing is withdrawing capital from a life assurance bond, although it's like effective income for you, but you can't use this exemption to pass that on. Now, what is normal expenditure is taken to mean habitual and requires a pattern of giving to be demonstrated. Where there's no evidence of any regular commitment initially, the revenue are prepared to accept that expenditure is normal once it has occurred 3 years. I mean, ideally, if you want to set up this sort of arrangement, have an email or whatever, or a letter to whoever you're going to be distributing to saying, I'm going to pass this surplus income on to you every year. And then even if you've only done it once, if you die, unexpectedly, maybe there'd be evidence that it was a regular commitment. But if you haven't got that sort of paperwork, the revenue will take it as being regular if they see it's occurred 3 times. And that would make all of the payments, then eligible for the relief. But normal expenditure indicates expenditure that, when it took place, accorded with the settled pattern of expenditure adopted by the transferor. So there has to be that evidence that they were intending it to be a regular payment. So potentially, as I was indicating in my example, it could apply to less than 3 payments if you died in the meantime. For it to be normal, there isn't any fixed minimum period during which the expenditure will have to have occurred, but it's got to be established that the pattern was intended to remain in place for a sufficient period, barring unforeseen circumstances. And it's got to be regarded as a regular feature of the transferor's annual expenditure. So, for instance, if you are on your deathbed, you've only got a day or two to live, and you make a resolution to make payments for life of your income, and you then make payments made the day before you die, that wouldn't count because there's no evidence, obviously, that there was any real intention. It would be a regular thing. The other thing is the amount of expenditure does not need to be fixed that you're passing on. It can be, for example, that you're agreeing that you will use this surplus income to pay care home fees for your elderly aunt, which obviously may vary and increase, but that would be fine. It doesn't have to be a fixed amount. And indeed, the recipient doesn't have to be the same either. If you've got a few children or grandchildren, you could pass it on to different people every year, as long as it's evidence that you are continually, regularly passing on your income. Now, the amount of the payments, they don't have to be specified, as I said, and there can be some sort of formula or standard, e.g., you're going to agree to pass on 10% of your earnings or to pay care home fees, as I said. And as far as the payees are concerned, it's enough that the general character or qualification for the benefit is established. So it doesn't even have to be family members. It can be needy friends and such like as well. Now, a really key thing is whether what you're passing on is income or not. And I obviously mentioned the issue with withdrawals from life assurance bonds. And it's not actually defined, the word income, in the Inheritance Tax Act, but it's taken to mean that the transferor's disposable income after tax and after all living expenses. And the IHT manual makes it clear that if it's actually a gift of some other asset that you're trying to claim is income being passed off, there'd have to be clear evidence that you had bought it out of income that you had and are just choosing to pass the asset on rather than the actual cash. And the word income does refer to current income. So it won't normally apply if the gift is made from a source which, although originally income, has been retained for a long time and has effectively become capital in nature. And a bit more on that, if the gift is made from a current account that includes capital receipts in it, where you've got a mix of income and capital, the revenue actually say they're not too bothered about that. They will accept that the gift is being made out of income, um, uh, if there is income in the account, basically, and it could have been made out of the income that's in there. So that's a bit of good news. And there is a case on this worth mentioning to you as well from about 20 years ago, the McDowell case, in which a number of gifts to the taxpayers' children were made out of a deposit account, and it contained substantial surplus income. And the revenue challenged it, and their argument was that where the money is transferred from a current account to the taxpayer's deposit account, it loses its character as income, which obviously sounds a bit harsh. And luckily, the special commissioners agreed with that. The special commissioners said that the payments were made out of retained income and it had remained income in character rather than capital. And their judgment included the following sentence: it was identifiably money which was essentially unspent income and which had been placed on deposit but not invested in any more formal sense. And based on that case, if you're accumulating income in a deposit account for a small number of years, you shouldn't have a problem. But there still can come a time when, after a long period of time, the revenue might successfully argue that it had become capital in nature. Um, Okay, so that's the regular gifts out of income rules. And I just emphasize there is no monetary limit on it. So, someone like Elton John, who's probably got more money than he knows what to do with, he could, probably pass on millions under that exemption if he wanted to, as long as he could show it wasn't reducing his standard of living and it was income that was being passed on. Now, those exemptions that I referred to, starting, with the annual exemption, etc., all of those are to do with lifetime gifts. For instance, just worth mentioning that if you're looking at someone's death estate, when they've died and they haven't made any gifts in the year, you can't take 3,000 annual exemption off the estate. It is only available for lifetime gifts. But the following exemptions apply to death and lifetime transfers. And the first one is gifts between spouses and civil partners. Now, those are normally unlimited, whether on death or by lifetime gift, but there is a 325,000 cap if the transferor is a long-term resident and the recipient is not. It used to be if the transferor was UK domiciled and the recipient was not, but that's changed to long-term resident. Gifts to UK charities and qualifying political parties. To be a qualifying political party, you have to have 2 MPs elected at the last general election, or at least 1 MP, and have had 150,000 votes. So there were many years when the Green Party didn't have any MPs, and you couldn't leave things inheritance tax free to them. Just as an example, and Aaron Banks, who you may remember from the Brexit campaigns, has had a case that's gone as far as the Court of Appeal, which he was in fact threatening to take to the European Court of Human Rights, which I think there was a bit of irony in, where he made donations to UKIP in the run-up to the 2015 election, and they failed that definition as well. And so his exemptions were chargeable to inheritance tax. And also gifts for the national benefit, like gifts to museums and things like that, are fully exempt. Okay, so those are the main sort of easy bits of lifetime exemptions and things like that. And obviously, every family should consider making use of them. Now, we need to talk a bit more about the inheritance tax side of trusts. This is probably about the most technical bit of the session, if you're not very familiar with it. So I'll try and go through it at a reasonable pace for you that you can follow it, and I will obviously pick up some questions when we have a break. So, first of all, with interest in possession trusts, what I'm going to do is firstly consider the position of them before Finance Act 2006. Now that's 20 years ago, and you might think, why are you doing that? Don't need to know the history of this. Well, the reason is because I've got it underlined that those still apply, those old rules, as I'll refer to them, still apply to what we call qualifying interest in possession trusts. Now, following the changes in Finance Act 06, some interest in possessions have a different treatment. the same treatment as happens with discretionary trusts. So what I'm going to do is go through the old rules, which still apply to a lot of interest in possession trusts. Then we'll explain to you which interest in possessions those rules apply to, which are qualifying interest in possessions. And then we'll look at the other IHT regime, which is called the relevant property regime. Now, if you've not done this before, or you never really understood it, if you had to study it at some point, the important thing to grasp is that the underlying principle in these old rules is that the life tenant, the person with the right to the income, is effectively treated like they're the effective owner of the underlying asset, even though they're not. They have no right to the capital. It's legally owned by the trustees, and it's eventually going to pass to a remainder man. But the life tenant under these rules is treated like the effective owner. And if you can keep that in your mind, then you'll find that the rules for different situations of things going into trust, coming out of trust, follow general inheritance tax principles. Right. So let's start with assets going into trust. Prior to Finance Act '06, those would have been potentially exempt transfers. Remember, I said they're effectively treating the life tenant like the effective owner. So if you create interest in possession for your son, it's the same for IHT as if you were giving the asset direct to your son. It's going to be it would have been a potentially exempt transfer in those days. And that would be unless the life tenant was someone like a UK charity or your spouse, in which case it would be exempt, just like if you'd given it to them directly. Now, the implications we've obviously just gone through with you of a pet is that there won't be any what we call lifetime tax. It's all inheritance tax we're talking about here, but we talk about lifetime tax being tax that's generated when you make a gift. And when we move on to other types of trust, you'll see that no lifetime tax, but there'll be death tax if the donor dies within 7 years, the donor being the settlor here. And it's exactly the same sort of treatment as if the gift had been made to an individual. Now, if you create an interest in possession in your will, which you can do, leaving assets, to income to my surviving spouse for life, assets to my children, say. If you do it by will or intestacy, again, think what would happen if you were leaving it outright to the life tenant. So if I was leaving it outright to my wife, it would be an exempt transfer, and it would be if I create an interest in possession for her on my death. But if I create an interest in possession for, say, my brother on death, what would happen if I was leaving assets outright to him? They'd be part of my chargeable estate. And that's what happens when you create an interest in possession trust as well. The trust property will be in the deceased's estate unless the life tenant is a spouse, UK charity, etc., in which case you'll get the normal exemption that would apply. So the fact that a trust is being created as a result of death doesn't alter what would otherwise be the charge on the estate if the assets were being left outright to the life tenant. Hopefully you can see that principle flowing through. Now, termination of life interests. It can be on death, life tenant dies, the capital passes. Can be earlier. It may be that the life tenancy was only for a specified term, like for 10 years or until the surviving spouse remarries or something like that. Or it could be that it was for life, but the life tenant voluntarily gives up their right to the income because they don't really need it, and they're happy for the remainder man to take over the asset earlier, rather than wait till their death. So we need to consider both situations. And if it happens while the life tenant is alive, that the termination of the trust happens and the capital goes to the remainder man, again, you've got to follow through the normal principles. If you're treating the life tenant like the owner, it's like the life tenant has made a lifetime gift to the remainder man. And that will mean that it's treated as if it's a pet by the life tenant, unless the remainder man is their spouse or a UK charity, etc., in which case it would be an exempt transfer by them. And it means that if the life tenant survives 7 years from when that capital passed from them, then There won't be any inheritance tax, but if they die within 7 years, it would be chargeable to inheritance tax, be treated like a lifetime gift by the deceased, even though they'd only had a life tenancy in it. And the other way that it can terminate is on the death of the life tenant. So you've got, um, life tenancy terminates, and then the capital passes, and the value of the settled property is included in the deceased's estate. Again, unless the person receiving the capital now is going to be the spouse of the life tenant or a UK charity, etc., in which case the normal exemption would apply. And if, assuming the exemption's not there, the trustees settle their proportionate share of the total IHT on the estate. And that then reduces the amount to pass to the remainder man. Now, let me do an example of that because it'll help clarify it for you, particularly if you're not used to dealing with these things. So let's say David died on the 14th of April 2005, leaving a net free estate of 825,000. That's, that term's used sort of his assets less liabilities. And out of that, he leaves £40,000 to Age UK, and the balance is divided equally between his three nieces. He was also the life tenant of a pre-Finance Act '06 trust, one that had been running, for the best part of 20 years at least. And I know we haven't gone through which interest in possessions are governed by these rules yet, still, but any that was in existence on budget day 2006 is governed by these rules. So what I've just been going through with you would apply here. He was also the life tenant of a pre-Finance Act '06 trust, and at the date of his death, the capital was worth 140,000. He'd made no previous lifetime gifts at all. So let's work through this. You've got, first of all, the net free estate, which is 825,000, which we said was going to be going to his nieces. And you would take off that the charitable legacy to Age UK, bringing the net free estate after the legacy down to 785,000. You then aggregate the trust capital in which he had a life tenancy in with that, and that brings the estate up to 925,000. And then the next thing that has to be done is to calculate the IHT on that full amount of 925. And that looks like this. There's a nil rate band of 325k, and then 600k at 40%, which is 240k of inheritance tax. And that then gets apportioned between the free estate and the settled property. And to do that, you've got to work out the average estate rate, which is the total inheritance tax over the total chargeable estate, which gives you an average rate of 29.946. And you apply that to both components, the free estate and the settled property. And it gets you to those figures. Now, one of the things you'll note from that, and it's important to be aware of if you've got trust situation like this, is the nil rate band does not get given to the free estate assets in priority. It's just given against the total chargeable estate. So effectively, the trust assets benefit from it as well to some extent. You then work out the average rate and you apply it across the two components. And the 203,000 odd is payable by the executors as part of the probate process. And who suffers that are whoever's receiving the assets in the estate, which in this example are the three nieces. And on the settled property, it's the trustees have got to pay it, although again there are provisions that they could go after the estate if they can't recover it, if the revenue can't recover it from the trustees pay it. And who suffers it? The remainder man of the trust, because the trustees don't pay it out of their own pockets. It's the remainder man of the trust that suffers it. So that's how it works. And there may be one or two of you thinking, what about residence nil rate band there? I obviously haven't covered that yet, but I will be doing so before too long. And in case you were wondering about it, there wouldn't be any here because a condition is that you've got to be leaving a home that you've used at some point. And obviously I didn't give any information on that either, but if assuming there was one in there, but you've got to be leaving it to direct descendants. And we said here that the estate was going to his nieces, so you wouldn't get any residence nil rate band in a situation like this. Okay, so those are the inheritance tax rules for as they used to stand before Finance Act '06. What happened in Finance Act '06 was when Gordon Brown was still Chancellor. He managed to complicate things significantly. We used to have one lot of rules for interest in possession trusts and another lot for discretionary trusts. And once you learnt them, you knew which you were dealing with. Since Finance Act '06, those rules I've just gone through only apply for qualifying interest in possessions. And other trusts come within what we refer to as the relevant property regime. That's the generic term for it. And previously, that was only used by discretionary trusts. And obviously, I will be describing that to you shortly. One thing I'll just emphasize here before we look at the list of qualifying interest in possessions is these days, since the budget in 2006, if you create an interest in possession by lifetime gift, it definitely comes within the other regime. It won't be a qualifying interest in possession with the treatment that I've just told you. So it won't be a pet if you set one up now, but we'll come to how the other regime works in a moment. The exception to that is if you set it up for a qualifying disabled person, effectively those are still governed by the old rules, and it would be a pet when you set it up, and the capital would come into the deceased estate when the life tenant died and things like that. Now, what are qualifying interest in possessions? Well, first of all, the easy transitional rule, any interest in possession that was in existence before the 22nd of March 2006, plus the following ones that have been created afterwards. And the key one to be aware of is an immediate post-death interest trust, which I will explain to you in a moment, because you'll still get a lot of those. And there is another type that's called a transitional serial interest, which was to do with transitional rules at the time. I'm not going to cover that today. It's something you'd rarely come across. But emphasize that all of those on that screen there are governed by the regime that I've just gone through with you, where the life tenant is treated like the effective owner of the trust assets. Now, an IPDI trust was something that was newly created in Finance Act '06, an immediate post-death interest trust. And to be one of these, it's got to be created on a will or intestacy. So it has to be a death trust, one set up on a death. And it must arise immediately on the settlor's death, and not have sort of funny terms in it where there's a delay in it being created after the death or anything like that. And the way I always describe it in lectures, just think of it as like a bog standard interest in possession. So if I die and in my will I say income to my wife for life, remainder to my kids, that will be an IPDI. If I say income to my brother, remainder to his kids, that will be an IPDI. A bog standard interest in possession set up on death is still going to be covered by those old rules. Okay. Moving on to the next type of trust, what we call relevant property trusts. And we'll just cover these before we have our first break. Now, we'll go through the situation of this is any trust that's not a qualifying interest in possession, except bare trusts, which are dealt with separately, as I said. So basically, it covers lifetime interest in possessions that you create now, unless they're for a disabled person, plus discretionary type trusts. Now, if you create one while you're alive, it's not a potentially exempt transfer. It's called a chargeable lifetime transfer. And we say that lifetime tax is payable to the extent the nil rate band is exceeded. And it's all inheritance tax. We just refer to it as lifetime inheritance tax to indicate that you're not needing a death to trigger it. However, if the donor, the settlor, dies within 7 years, it's also subject to death tax. And your initial reaction might be, well, who the heck would set up one of these if you potentially got a double charged tax like that? Well, as we'll show you, the lifetime tax is at lower rate. And if the donor does die within 7 years, there is always credit given for any lifetime tax that was paid. So the worst, scenario can ever be a 40% charge. The tax rates that apply, and this is perhaps the most difficult sort of esoteric point of the whole session. So I will try and go through it slowly and make sure you understand why it's the case over the next 5 minutes. The tax rates for lifetime tax, if the donor pays the tax, it's 25% above the nil rate band. If the trustees pay the tax, it's 20% above the nil rate band. And if you bear with me, I'm just going to explain that to you. With death tax, it's always 40%, subject to taper relief and then a deduction for any lifetime tax that was paid. With taper relief, reducing your death liability perhaps down to 20% of the full amount, it could be that in fact the lifetime tax exceeds the death tax, and that would bring your death tax down to nil, but you don't get any repayment of any excess lifetime tax. Similarly, you don't get any repayment of the lifetime tax if you survive 7 years, if the settlor survives 7 years. And we don't have this who's paying the tax on the death tax because the settlor has died. That's why the charge has happened. It's always the trustees who are going to be liable. So let's do an example trying to explain to you what's going on here. John makes a gift of £500,000 to a discretionary trust and has got full nil rate band available. But he's used his £3,000 annual exemption against other gifts, so we can ignore that in the example. We're going to show how much lifetime tax is payable and how much is left for the trustees to invest if the trustees settle the tax or if John pays the tax. Now, I'm going to just go off at a tangent here, but this is to help you understand what's going to come up when we do this example. I know there'll be a few of you young enough not to really remember these days, but probably most of you listening will remember the days prior to Finance Act 2016, when it used to be that if you received bank interest, they used to withhold basic rate tax on it. So that if you were entitled to interest of £100, they would have, the building society or bank had to withhold 20% and pay it over to the revenue, and you only received £80. Now, the tax, if you think about what the tax is in relation to the net interest that you're receiving of 80 quid, you can get to that figure by multiplying that net amount by the tax rate 20 over 100 minus the tax rate, which is 80. So multiply it by 20 over 80 or a quarter or 25%, it will get you to the £20. Now, if you've never seen it before, that formula I've got there of starting with a net amount to find out what the tax is of multiplying it by the tax rate over 100 minus the tax rate, it always works for any tax: corporation tax, capital gains tax, inheritance tax. And we're going to use that in a moment, as I'll explain to you. But I just wanted to, show you an analogy which might help you follow it. Now, when we look at this example, we said, first of all, what happens if the trustees pay the tax? And you need to appreciate what inheritance tax is doing. It's doing something that's different to capital gains tax. The principle of capital gains tax, when you sell an asset, is how much has it gone up in value by over your period of ownership. Whereas with inheritance tax, what it's trying to tax is how much your wealth is falling because of this disposition you've made. Okay, that's the principle of inheritance tax. How much were you worth beforehand? How much were you worth afterwards? That loss of value is the value that is subject to inheritance tax. So we've said here that that he's putting £500,000 into the trust. And if the trustees are going to pay the tax, how much does his wealth fall by? £500,000, doesn't it? No, it's not a trick question. And so what we say is that this is like a gross transfer. The gross fall in value of his wealth is £500,000. The excess over the nil rate band for him is 175k, and therefore it's taxed at the main lifetime rate of 20%, and it would give 35,000 of inheritance tax that's going to be payable by the trustees. And that will obviously leave the trustees with £465,000 to invest. Okay. Now, If instead John pays the lifetime tax, so he says to the trustees, here's £500,000, you go ahead and invest it, I'm separately going to settle the IHT on it, then how much does John's wealth fall by because of this disposition? It's not 500,000, is it? It's 500,000 plus the tax. And therefore, we say that the 500,000 that's going in is a net transfer, and the gross value that you're going to tax is that plus whatever the tax is. And you therefore say the gift is net of the nil rate band is 175k, and you're going to use that same 25% of the net that we said it was for the building society interest, because the gross rate is 20%. And if you multiply 175 times the tax rate, 20 over 100 minus the tax rate, 20 over 80, you'd get to the same figure of 25%, and you'd find the tax is 43,750. Now, before I just complete this slide, in the legislation, it's the donor who is primarily liable for settling the lifetime tax that arises on a chargeable gift, but the trustees may assume liability for doing it by agreement, but it's primarily the donor's responsibility. And you can see that would produce a higher tax charge. Now, at which point a lot of people understandably immediately say, well, why is the donor ever going to end up paying the tax if it's going to be less tax if the trustees pay it? Well, let's have a look, because that would be 43,750. And then we say, how much is left for the trustees to invest? Well, remember in the previous example, it was, I think it was, go back the figure, I've forgotten it. Hang on. It was, 465k. In this case, it's 500,000. So you end up paying a bit more tax, but you've got more money left in the trust. And in fact, he could have organised this differently. What he could have done, because his gross outlay is 543,750, including the tax, he could have said to the trustees, here's 543,750, you settle the tax. And if that had happened, the amount of tax that would be payable above the nil rate band would be at a 20% rate, and it would come to 43,750. So hopefully you can see there's a bit of sort of swings and roundabouts about how all this works. More tax is payable if the donor pays the tax, but it leaves more in the trust. And you could get to the same situation either way, as that slide is showing you. So probably new to a lot of you, and I know it's not the easiest thing to grasp when it's been gone through for the first time, but that's how you deal with lifetime tax on a relevant property trust, like a discretionary trust or a lifetime gift into an interest in possession trust these days. Okay, at that point, I'm going to break for coffee, let you clear your minds. We just finished this bit off, which doesn't take very long. And then we will get on to talking about transferable nil rate band and residence nil rate band a bit, and then later we'll get onto the business areas and the pension areas and things. And with the stuff we've covered in the first hour, hopefully it'll give you a greater chance of following all that clearly. So I'm just going to mute myself for let's take 10 minutes until 20 past 10, and we'll carry on, and we'll have a shorter break later, just so you can stretch your legs. Thanks. Gentlemen, welcome back. Hope you've managed to stretch your legs, have a coffee, etc. For those who joined late, just say we had a few technical issues, and I think you probably still can't actually see me, but hopefully you can hear me okay. And we're going to be running till about 10 past because we had a slight delay in starting. I'm going to very quickly run through a few of the questions that have come in. They're all good ones. I won't do them all now, but I'll pick up the others when we finish. Is it okay to simply gift a house to an adult issue with no tax implications, save for surviving 7 years? For inheritance tax, yes, but if it's not covered fully by PPR relief, obviously you could have capital gains issues, so you need to be careful of that. Second one, if the parents gifted assets to a discretionary trust, are the parents still liable to the income tax if over £100? This is if it's a discretionary trust for a minor. Yes. If income is treated as the parent's income under that same rule, how is the capital treated when you're transferring the assets to the minor children? Just as normal, it's just a special rule for income tax, doesn't affect the capital treatment. Re lifetime gifts, if the parent pays for the wedding, is that deemed to be a gift covered by the 5K? I think you can normally uh, deal with the actual payment of the wedding under I didn't mention it, but uh, what they call reasonable family expenditure. I think paying for a wedding would come within that, and the 5K would be a separate gift, like towards buying your first house or paying for your honeymoon or whatever it might be. Um, there's quite a long question here, but I think it's worth just quickly mentioning. I'm dealing with an intestacy where the lifetime gift of 370K was made 3 months before the death of the life tenant, before the death of the client. Sorry, the relationship with the beneficiary is acrimonious, and I'm just wondering what the best way is to tell them that there's potentially going to be tax on that gift. Delicately, I think is probably the answer, but more seriously, he won't want to pay it. Not sure what he has done with that cash. But you're saying the executors will be liable if they can't get it, if the revenue can't get it from the beneficiary. That is the case. I mean, it's the beneficiary's legal liability, so it should be pursued by the revenue with him, but they could come back. So if you're dealing with the estate, I wouldn't distribute all of the assets until this has been resolved. Otherwise, if you've distributed everything out and the revenue come after you for that tax, you'd be personally liable for it. Just maybe one or two more, and then we must move on. Small gifts exemption. Is there any limitation on the number of donees? No, there isn't. Is there a minimum time for the regular gift? No, I think we really covered that. But you'd expect it to be at least annually. If you're talking about it being regular, and normally you try and do it more regularly than that. Can the 3K, I presume referring to annual exemption, be given to a minor? Yes, can be given to anyone. Under the surplus income rules, can a client pay from previous year's income as long as the income remained in his non-savings account? Yeah, that should be fine. Does it need to be per tax year, or can we go back, say, 2 or 3 years altogether? Not sure what question that is. Sorry, what that relates to. And finally, please, the last one I'll deal with, or the last two I'll deal with. Please explain life tenant. Life tenant is in an interest in possession trust. It's the person who has the automatic right to the income or to use the assets rent free. And please clarify if an IPDI is before or after the Finance Act '06 rules. It's something that came in Finance Act '06 to say that if you set up a bog standard, interest in possession in your will, it will still be governed by the old rules. It wasn't a term that existed prior to Finance Act '06, but it wasn't needed because all interest in possession trusts were treated that way at the time. So I will leave that there because we need to get onto other things, but I'll come back to the questions and try and pick up the others and any others that come in probably when we get to the end, because there won't be much time when we have a short break later. Okay, so just before the break, we were talking about the charges that arise on relevant property trusts, discretionary trusts, and these days, interest in possessions created by lifetime gift. Talk about the charges going in. Once the trust is established, then there are two types of charge that apply to it. One is called a 10-year or principal charge. And basically, it's every 10 years of the trust's life, there's like a deemed disposal of trust capital on which there's an IHT charge. And if any of you dealt with it, you'll know the calculations are pretty complicated and certainly beyond the scope of what I'd be covering here. But know that they produce a maximum rate of only 6%, and it's often a lot lower than that, can even be nil. So you're not talking about 20% or 40% every 10 years. But obviously, if the trust runs for decades, that can, become sizable over time. And the other thing is an exit charge, which is an IHT charge when capital is distributed from the trust. And it's a complicated calculation as well, and it interacts with the 10-year charge calculation. And the starting point for it is that it's based on the rate at the most recent principal charge, or if you're in the first 10 years of the trust life, what was the effective rate of tax on the assets going in? And then there are a number of complicated steps in it. And in case you think I'm over egging that a bit, again with a maximum rate of 6%. In case you think I'm over egging it, just to give you one facet of the calculation, if you've not dealt with it, in an exit charge calculation, you have to split every 10-year period into 40 quarters, and whichever quarter the distribution of capital happens in affects the rate of exit charge. So, just from that, you'll see it's pretty complicated. And all you really need to take away from it today, if you don't deal with it regularly, which will be the case for the vast majority of you, is that there are these charges. They're relatively low, and the calculations are very complicated. Now, note that, as I've already said, a lifetime interest in possession is now governed by these relevant property regime rules. And so if a life tenant dies, one that's been created, since Finance Act '06, if a life tenant dies, the trust capital does not come into their estate because it's not governed by that regime. Instead, there'll be an exit charge calculation done as capital is distributed following the termination of the life tenancy. So there'll be an exit charge at that time. Okay, so I mean the good news for you is we've probably got through the most technical bit of the session. If you did find that a bit of a struggle, I wouldn't blame you. Right, trusts for children after Finance Act '06. Some of you may remember accumulation and maintenance trusts, which were very advantageous IHT wise, could be set up for children by anyone, including parents. Those got abolished in Finance Act '06. And what we have replacing it is much more restrictive. There's something called a trust for a bereaved minor. And the key conditions are that at least one parent, step parent, or legal guardian has got to be dead. And the trust derives from that parent's will or intestacy. So this has to be a death trust, one created on death. And the assets have to pass at age 18. You can't set a higher level on it. Now, we mentioned earlier that you obviously you often wouldn't want assets passing at that lower an age. And so many people won't want to use these for that reason. But if you do include one of these in your estate for a minor child that you've got when you die, then the assets will still be in your estate, just like they would be if you were, leaving them outright to the child. But there won't be any 10-year or exit charges once the trust is created on your death. That's the IHT advantage of it. And that's even if the minor, under the terms of it, is entitled to the income as it arises. There's no exit charges or principal charges. The other trust they introduced in Finance Act '06 is basically a similar thing, but where the capital can pass up to age 25. Again, got to be a death trust, and that gives a bit more comfort that the child is not going to be inheriting at such a young age. If you're happy with 25, and the IHT advantages here are that you don't get any 10-year or exit charges up to the age of 18 for the individual, and in fact there are never any 10-year charges even if capital even past 18, because effectively they take the 18th birthday as being the starting date for 10-year charge purposes. But there will be an exit charge on capital distributed after the 18th birthday. And again, that's similar complicated calculations, but with a maximum effective rate of 4.2%, not 6%. And how you end up with that is the latest age at which you can make a distribution is 25. And you starting from when they're 18, you're 7 years through the 10-year period. So the maximum charge becomes 0.7%, and that's how you get the 4.2%. But if you don't want those sort of restrictions, and you want to set up a trust for children in your will, then it's just going to have to be an ordinary trust governed by the normal rules that we discussed previously. If it's an ordinary discretionary trust, it would have 10-year charges arising, starting on the 10th anniversary of the trust creation, etc. Okay, now we will come back and be mentioning trusts and things. That's why I've had to cover all that. Just to say to you, even if you're an IHT expert, it's now a lot more difficult dealing with all that than it used to be before Finance Act '06, because you could get a trust deed on your desk and be asked to deal with it, And you could very quickly, by reading the trust deed, establish if it's a discretionary trust or an interest in possession trust, and you knew what the IHT regime was. Now you've got to consider things like, when was the trust created? Was it created while the person was alive or dead? Does it actually meet the conditions for being um, a trust for a bereaved minor? Things like that. There's a lot more that you've got to consider, even when you're dealing with IHT a lot. Okay, moving on. Different topic. Transferable nil rate band. Now, this was first introduced for deaths on or after the 9th of October 2007. And prior to that date, husband and wife had a nil rate band. Let's use the current one of 325k. And if I died and left everything to my spouse, it would be an exempt transfer, which sounds good for IHT purposes. But it meant all the combined wealth was then in my wife's name. And when she died, she just got one nil rate band and mine was completely wasted. And they introduced transferable nil rate band, to avoid that sort of situation. It used to be standard practice that if the combined wealth was going to be above a nil rate band, that on the first death, it would say that you were going to put assets into a nil rate band trust, usually for spouse and partners, spouse and children. A nil rate band trust means that in your will it says, I'm leaving an amount equivalent to the nil rate band when I die into trust for these people. They normally be into a discretionary trust, and that would have used up your nil rate band. And then it meant that when your wife subsequently died, she'd still have her own nil rate band to go against her own assets. And it also meant that those assets that are in the discretionary trust, which she's a beneficiary of, they don't come into her estate at all. Because remember, you only bring assets from a trust in if it's in a qualifying interest in possession and the person had a life interest. So that was what used to happen. So let's look at what the impact of transferable nil rate band has been. Well, first of all, just make sure you're clear on the mechanics of it. The nil rate band has been frozen for so long, everyone just thinks about it being a second amount of 325k you'll get, but it's actually the proportion of the nil rate band from the first spouse or civil partner to die that is used to uplift the second nil rate band. And it applies even if the first spouse died before the 9th of October 2007. It's if the second spouse died after that date. So if you were dealing with someone now who unfortunately was widowed back in the year 2000, you could still use transferable nil rate band if you had enough evidence that the first spouse to die hadn't used up all of their nil rate band. So a quick example on the mechanics of it. If on the first death, the chargeable estate, that's the amount that we're setting against nil rate band, so it's after exemptions, etc. And the nil rate band at the time was 300,000, then 50% of the original nil rate band would be unused. If the nil rate band when the survivor dies has gone up to 400,000, then that gets incremented by 50% to 600,000. So you see, it's not the absolute amount of unused nil rate band, it's a percentage increment. You could end up, unfortunately, with more than one deceased spouse. Some people do. So let's say Andrew died leaving a chargeable estate of 120,000, and the nil rate band at the time was 300k, so 60% was unused. His wife remarries. The new husband, Brian, subsequently dies, leaving a chargeable estate of 97.5k when the nil rate band has gone up to 325k, and that means the 70% unused. Now, when the wife dies, the nil rate band is gone up to 500,000. And in theory, you can gross up for both of those. So if someone's acquired 6 or 7 deceased spouses, you could have a multi-million-pound nil rate band. But no, you can't, because although you can gross up more than once like that, the maximum is 100% increment that you can have. And so she would end up with a nil rate band of 1 million there. So that's the actual mechanics of how it works. And if the nil rate band does ever start changing again, remember it's a percentage increment is what you're dealing with. Now, let's look at the impact on nil rate band trusts. Suppose a husband died in 22-23, leaving his 325k estate into a nil rate band for spouse and children. So he's utilising his nil rate band against that trust on his death. And the wife subsequently dies when the nil rate band is 420k. The total combined nil rate band that they'd have over the two deaths is 745k. If instead he'd actually left everything to his wife as an exempt transfer, on her death, the nil rate band would be doubled to 840k. And so you can see that, setting up a nil rate band trust like that, you could end up with less nil rate band overall. But that's not of itself a particularly key issue, because what you've got to be considering is really how the nil rate band is going up compared to the value of assets that would otherwise be in the trust. Because remember, they're going to be sheltered from IHT when the second spouse dies, because they don't come into the estate. So a nil rate band trust, even if you're not getting an IHT saving from it, and we'll show you in a minute how you might do, but it can still be useful if asset growth over the period between the deaths is likely to exceed the increase in the nil rate band over the same period. Now, 20 years ago, if I was lecturing on this, I could be talking about making assumptions about, general asset growth for smaller companies or for property and things like that, or gilts, whatever's going into trust. And the nil rate band generally went up by inflation every year. Obviously, with the economic story and everything and how taxes these days, that's all gone out the window a bit, and it's a bit more guessing at things. But you do have to do your best to see whether it would be worthwhile and advise people, accordingly, that it's difficult to be certain on this. Let's do an example. Jimmy dies when the nil rate band is 325k, and he leaves his entire estate to his wife of 650k, which is conveniently double the nil rate band. On her death, the wealth he left her is worth 1.3 million, so it's doubled in value, and the nil rate band has gone up a lot to 500,000. And that would be doubled as Jimmy's nil rate band was unused. And therefore, the IHT on her wealth is going to be the excess on that wealth on her death is going to be the excess of 40% over two nil rate bands, which will be combined 1 million, and therefore is 40% of 300k, which is 120k. So hopefully you're all okay on what we've done there with the numbers. You get a doubling of the nil rate band there. Now I'm going to amend that example to say, suppose instead he'd left half of his wealth into a nil rate band trust. And we're going to assume there's equal asset growth across all categories, what goes in the trust and what goes to her. So we've got that on the wife's death, there'll be no IHT charge on the assets in the trust. They don't come into her estate. The assets she received directly, which was half of his assets, have now doubled in value to 650k. And after you set off her nil rate band of 500,000, you end up with an IHT charge of 60k. And you've therefore got a lot less, because just go back to the other figure, that's 60k. And we said if you'd gone for the fully exempt transfer from him and then doubling of nil rate band, you ended up with more IHT of 120k, despite the fact the nil rate band's gone up substantially. And the reason for that is that the assets have been going up more quickly than the nil rate band. So by having half of them sheltered in the trust and not taxed on her death, you end up with an overall saving. So hopefully that makes sense. But it really does depend on how long the person lives, what assets are in the trust, what growth rates you get on it, and etc. So what happens to the nil rate band in the meantime? So in summary, although they sometimes no longer provide a tax saving where they previously did for couples, discretionary trusts are still nil rate band discretionary trusts still frequently used for protecting wealth from IHT on the second death. And the issues to consider is really whether the growth rate in the trust after costs of running the trust are going to exceed the rise in the nil rate band over the survivor's remaining life. If not, a trust is probably not tax efficient for sort of mid-wealth families, if you like. But they may be needed for other reasons, like flexibility in dealing with changing circumstances, which obviously discretionary trusts give you. Protection of assets on divorce or bankruptcy. If you leave assets outright to someone, and they get addicted to online gambling and go bankrupt, that's lost. If you give it outright to them and they get divorced, those assets are shared on the divorce. Whereas if you've left assets in trust for them, normally in those situations the assets in trust are not going to be touched legally. And also planning to avoid care home fees, and it's not an area I have any specialism in, about trying to put assets into trust so they're not in the estate of the survivor should they need to go into care. But I know that my rather limited knowledge in that area, but I know that local authorities, etc., they can look at whether things have been done to deplete the assets of someone if they themselves have been giving them away, going back, I think, indefinitely. But you'll often get that sort of thing as well. And another thing which we'll be covering in a moment, the residence nil rate band, where that starts getting tapered away. If your estate before release and exemptions goes above 2 million, if you've put assets into trust on the first death, it reduces the chances of the surviving spouse having their assets above 2 million themselves and therefore having a restriction on their residence nil rate ban. But we're going to cover that shortly. Quick question for you. What if the husband has died, so you're not planning in advance? The will was written 8 years ago and sets up a nil rate ban discretionary trust for the surviving spouse and children. And the family would actually now just prefer that everything goes to the spouse, and they take advantage of the of the transferable nil rate band rules. They don't need the complications of the trust. The children are now all adults, say. And what you can do with it, the easiest way of dealing with it, and we did actually have this scenario in my family, about 5 years ago, where there was a will written when kids were small with trusts out that weren't really needed. The best way of dealing with it is ask a lawyer to do a deed of appointment under Section 144 of the Inheritance Tax Act within 2 years of the date of death. Because Section 144 says that if an appointment is made out of a discretionary trust that's arisen on death within 2 years of that death, it can be treated as if the assets never went into trust at all and instead were left direct from the deceased to whoever's now receiving them. And if you do that, it's therefore treated like the assets have gone straight to the spouse. And you then would have the situation that the family now want. And you get the exempt transfer on the husband's death because of that, and transferable nil rate band then subsequently applying. So be aware of that. So it happened in my family. It's quite a common thing to happen. All right, let's look at residence nil rate band as well. I think I mentioned in passing earlier that the detail of this is unbelievably complicated. One or two of you listening may be aware of that. I am going to do an example which will show you it's a bit complicated, but without delving into all the ins and outs of it. So it's formally called the residential enhancement to the nil rate band. It's been around since April 2017, and it's a new additional nil rate band that's become available, and it only applies where a home is passed on death to direct descendants of the deceased or their spouse or civil partner. So if my son had unfortunately predeceased me, I could leave a house to his widow and it could be covered by this extra nil rate band. And this can be whether it's on a will or intestacy. There's very limited availability if it's used in trusts. It's only available if it's a bare trust for a lineal descendant, if it's an IPDI trust for a lineal descendant, i.e., remember that's a will trust set up these days, a bog standard interest in possession to my son, interest in possession, remainder to my grandchildren or something like that, and a property is going into it. You would be able to have a property that's been a home is going into it. You would be able to have the residence nil rate band. Is a disabled person's trust for a lineal descendant, an 18 to 25 trust, or a bereaved minor's trust, any of those. But if you're just generally putting a property into a discretionary trust, you will not get residence nil rate band in it. On it, it has to be one of those qualifying types of trust. Now, the basics of it, it was phased in over 4 years. So if you're looking back to when someone died previously, you might have a lower amount. And since 2020 to 21, it's been 175,000. And it means that a couple between them, if they're making use of this, can leave up to £1 million of wealth to their children, as long as enough of it is represented in their house, 2 nil rate bands and 2 residence nil rate bands. With high value estates, this gets tapered away. And the taper threshold is 2 million. And that's the value after deducting normal liabilities like unpaid tax bills at death and mortgages and things like that, but before any reliefs and exemptions, including spousal exemption, charitable exemption, business property relief, anything like that. It's your estate before those things. So what happens then is that the residential enhancement is reduced by £1 for every £2 of excess value, and it reaches a stage when it's that there is none given. And we will find that sort of restriction come up when I look at the pension stuff with you, and I'll do an example that brings this in. Now, the main conditions are the property must have a qualifying residential interest. And that's basically like it is for capital gains tax. If you're more familiar with that for PPR relief, you have to have lived in the property as your residence at some point, with enough time to establish it as being a residence of yours. And if you've got more than one of those when you die, the personal representatives can nominate which one is the qualifying residence. Property's got to be left to a child, grandchild, or other descendant, or their spouses or civil partners. And it includes step relatives, adopted relatives, and foster children. If a guardian is appointed for someone under 18, they are treated as a child of the guardian for these purposes. Now, where it really gets complicated is transfer of unused entitlement. Like the normal nil rate band, it can be transferred, and it's a percentage increment up to a maximum of 100%. And if the first spouse or civil partner died before the 6th of April 2017, which was when this formally came in, they are deemed to have had a residence nil rate band available of 100k for transfer purposes. And as I said, it's restricted where the estate was more than 2 million. Now I'm going to do an example with you, partly to show you how complicated it is, but it'll also give you an idea how it works. So Thomas dies on the 27th of July 2015, which obviously is before the rules came in, but we've just said there will be a deemed 100,000 worth of residence nil rate band. His estate was valued at 2,060,000, including a share of a home worth £500,000, and he leaves everything to his wife. She dies in 2026 with an estate valued at 2.24 million, and the home is now worth 1.15 million. She leaves 200,000 to charity and the balance to her 3 children. So she's obviously leaving most of her estate to direct descendants. No lifetime gifts have been made. Let's look at how the numbers work on this. So to start off with, you'd say that she's entitled to a basic nil rate band plus the one transferred from her husband, and the nil rate band has been 325k since 2009. So it's going to be another 325k. The percentage uplift is just uplifting by that amount. Now, the residential nil rate band that can be transferred to her from Thomas, you've got to go back to his death when he has a notional residence nil rate band of 100,000, and you say that that's going to be restricted because his estate is exceeding 2 million, and you lose £1 of residence nil rate band for every £2 of excess asset. So 60,000, i.e. a restriction of 30,000. And that would bring the sort of notional nil rate band for him down to 70,000. And what you then do is you say, okay, she can have a 70% increment on her own nil rate band, because his one ends up being 70,000 out of what would have been 100. That's 70%. That will be what the increment is that's available to her. Now, Jean's own residence nil rate band is 175k. That therefore gets incremented by 70% to 297,500. That's not the end of the complications, because you've then got to consider her estate and how uh, large it is, what the value is. And her estate, we said, was 2.24 million. So the excess of that, 50% of the excess of that over 2 million is a restriction. So that'll be a restriction of 120,000. That actually leaves her with 177,500 of residence nil rate band, rather than the full 297,500 that she would otherwise have been entitled to. And that means her total nil rate band is therefore 650 plus 177,500, which gets you to 827,500. And the IHT payable, we said that her estate was 2.24 million. Remember that the tapering is done before reliefs and exemptions. That's why we based it on the 2.24 rather than the 2.04. But there is a charitable legacy of 200k, and that brings it down to 2040. And the IHT payable here, you've got that total nil rate band of 827,500 at nil. And the balance, you might be expecting 40% there, but it's a chance for me to remind you of another rule to do with wills that George Osborne introduced, that if you're leaving at least 10% broadly of your estate after nil rate band to charity, then the tax on the rest of it is reduced to a 36% rate. And if you take the estate after nil rate band, it's clearly a lot less than 2 million, and 200,000 is being left to charity, and therefore you get that reduction in rate down to 36%. But you can see how complicated it was to calculate that, and it's a nightmare. And there's also, to be fair, most chancellors, budgets announce what they think are clever things and then spend the next three budgets unwinding the knock-on effects of what they've done. When George Osborne announced that he was introducing the residence nil rate band, he did actually say in his speech, we recognise that this could distort the housing market by allowing people to, or causing people to hang on to their houses. He said, so we're going to introduce an equivalent relief, which is known as downsizing provisions, where someone has sold their house but leaves other assets to their children, or has downsized from a more valuable home to a smaller one. And the key bits of that are that the deceased disposed of a home on or after 8th of July 2015, which was the budget date when this was announced, and either downsized to a less valuable property or ceased to own a home. The former home would have qualified for the residence nil rate band if it had been retained, and at least some of the deceased assets are being inherited by their direct descendants. And the amount of the downsizing addition generally is going to be equal to the residence nil rate band that's been lost because the former home is no longer in the estate, although it can be a bit more complicated than that. It also depends on the value of the other assets in the deceased estate that are actually being left to the direct descendants. So it's an absolute nightmare dealing with it. The personal representatives have got to make a claim for the downsizing addition within 2 years of the end of the month in which the person died. And so basically what you need to do is make sure, if you have had a downsizing, that all the details of the transaction are there with the dates, etc., so that it's available should you die, that this could be dealt with. Say, don't underestimate how complicated it all is. Okay, let's move on and look at areas to do with family businesses. And I'll start with business property relief. Now, I've put it, as I said at the introduction, for anyone who missed it, I've got a separate bit at the back of the pack, which is for self-study to do with agricultural property relief. And other than here, I'm not mentioning it or mentioning any of the detail of it. But the restrictions on 100% relief that first came in 1992 have been legislated now in Finance Act 06. But they did make an important concession. In fact, after the budget in the winter, a week or two later, you may remember, it had going to be that only a million would qualify for 100% relief. It's now 2.5 million of your combined net qualifying agricultural and business property. and there's 50% relief for any higher value. And that 2.5 million, 100% allowance is going to be transferable between spouses if it's not used on the first death, a bit like, the nil rate band is. And it's being frozen until April 2031, like most sort of allowances and rate bands, etc. are. And also remember that owning qualifying trading company shares that are listed on markets like AIM, they've previously been treated like unquoted companies, and you've had the 100% relief on them. That's now being cut just to 50%. There is no 100% on those. It's just a flat 50%. But it doesn't. If you've got any AIM shares like that, it doesn't impact on any other qualifying property you've got in terms of the use of the 2.5 million allowance. Obviously, those changes could potentially create significant IHT liabilities where they didn't previously exist. It was announced 18 months ago, so there has been a lot of time to be planning for it, as people have been doing. Does also include issues where business assets are held in trust, but I'm not going to get into that today because there are a number of complications with anti-forestalling rules and things like that. All businesses need to consider their IHT position. I'm sure they have been doing so, but if they haven't, including reviewing wills and considering whether making some lifetime gifts of qualifying property may be worthwhile. And we're going to be talking more about making lifetime gifts of family company shares and things a bit later. There are anti-forestalling provisions that meant that the new rules basically applied for lifetime transfers on or after the 30th of October 2024, if the donor survived past the 5th of April, because the new rules came in on the 6th of April. Another bit of good news is if you do end up having to pay some tax following a death because there's qualifying business property, they have confirmed that it will be payable in 10 equal annual instalments rather than all being due 6 months after the end of the month of death. And those instalments are going to be interest free as long as you pay them on the due date. So, that's good news. I thought I'd do a quick example before we get on to talk about some of the practical planning stuff, just to show you some numbers of how this would all now work. So let's say Sadiq has owned the whole of an unquoted trading company for many years. When he died on the 15th of February 2027, he bequeathed the shares to his younger brother Zahir. It had a net asset value of 4.4 million. The shares had a net asset value of 4.4 million, I should be saying there. He also left AIM shares worth 400,000 and other non-relievable property valued at 600,000 to his only daughter Layla. The AIM shares qualify for business relief at the lower 50% rate now, but they don't impact on the 2.5 million allowance for 100%, which is available to the other qualifying property. That will therefore be set against the unquoted trading company shares that Sadiq has got. And since the value of that business exceeds 2.5 million, there'll be 50% relief on the excess value. Now, if we put all that into a chargeable estate, we've got the unlisted trading company shares, which get business relief like that, bringing you down to 950,000 still chargeable, which wouldn't have been until these changes. You've then got the AIM shares, which previously would have been 100% relieved, but are now only 50% relieved. And then you've got the other assets, making the total chargeable estate now 1.75 million. When you do the tax, you then assume he's just got a nil rate band. So we haven't mentioned anything, about residence nil rate band or anything like about residence being passed or anything. On the first 325k at nil, then the balance at 40%. You then got to work out the average estate rate, like we did on an earlier example, which comes to 32.571%. And you apply that to the unlisted trading company and AIM shares, which are qualifying property where you can have installment option. And that's going to be payable 10 equal annual installments starting 6 months from the end of the month of death. And you apply that rate to the other assets left to Layla, which was the 600,000. And that IHT of 195,000 will be due in full 6 months from the end of the month of death. although the executors may need to pay it earlier to get the grant of probate, but interest would start running if you didn't um, uh, pay it by that date. So that's an example of qualifying and non-qualifying property and showing you how it was split and how you determine how much has got to be paid when. So I hope that's useful for you. So let's talk about when you get BPR and when you don't, having dealt with those numbers bits. Right, to qualify, the assets have got to be what's called relevant business property. It doesn't say, like it does for most CGT reliefs, that it's got to be a trading business. It says it's got to be relevant business property. And the qualifying condition normally is that the donor must have owned the property for at least 2 years before the transfer, whether it's a lifetime transfer or on death. There are some rules like replacement asset rules. If you've sold one business, reinvest in another, and then die shortly afterwards, you as long as you've had qualifying property for 2 of the 5 years, you'd be okay. But generally, you've got to own it for 2 years. Now, relevant business property is available on property consisting of a business or an interest in a business, unquoted shares in a company, or controlling holdings of unquoted securities in a company. But it excludes businesses that consist wholly or mainly of dealing in securities, shares, or land and buildings, or the making or holding of investments. And so it's not a trading company definition, but it is getting closer to it, because a business that consists of the making or holding of investments is excluded, and that includes property rental type businesses. They are excluded. You can't get business property relief at all on those sort of businesses. What is meant by wholly or mainly? Remember, excludes businesses that consist wholly or mainly of, and wholly or mainly is taken as being more than 50% excluded activities. And in the revenue manuals, it will refer to a case called Farmer, where they say that you've got to look at the things as a whole. You don't just focus on the relative value of the assets that are non-qualifying and those that are qualifying, or the turnover. You've got to look at the big picture, including management time, how much is spent on each bit of the business. And if doing all that, they feel that more than 50% exclude activities, then you don't get any business property relief at all. Now, that may seem quite a big cut-off, 51% exclude activities, you don't get any BPR. 49% you do, and remember, it could be at 100% for you fully. If you have got significant amount of non-qualifying activities, you're very likely to have the business property relief restricted under the accepted assets rules, which I'll be coming on to very shortly. Okay. Now, with property businesses, you need to be careful. Property development, like construction companies, qualifies, but property rental businesses do not. And even in the days when we had the special tax rules for furnished holiday lets, they basically didn't qualify for IHT relief at all either. There was one sort of rogue case with some special circumstances where they did, but normally you didn't get any relief. And that's because the revenues argue is that property businesses are all to do with holding an investment, which is the property. Now, it may be some of you amongst your client base have a livery business or livery business. I think you can pronounce it either way. And a useful case for you, which is an upper tribunal case, so setting a binding precedent, was involving a livery business. And this consists of 30 acres of land, and the PPR, the personal representatives, claimed business property relief. And as a fallback position, they claimed agricultural property relief as well. And the agricultural property relief failed because that doesn't normally relate to equine activities. So I won't bother discussing that. But the arguments were that there was no doubt there was a business being operated and that it was properly business property that you were dealing with. But the revenue's position that it necessitated this land to make the business viable, which basically all the value was there in terms of holding this land, and therefore it was investment activity, which is the way the courts have normally looked at this sort of thing. And they said that all the sort of stuff that was provided about the work being done, to try and show it wasn't just holding an investment, they said that's all just incidental to holding this investment land. And the appellant's position was basically that the man on the Clapham omnibus would say this is clearly a proper business, it's not just holding an investment. And they said we provide a lot of services over and above, basic livery provision. I'll list them up there for you. It's the only lecture I ever get to mention worming products. And what the first tier tribunal said was that in these circumstances, they felt it wasn't just investment activity, that it was relevant property. And it got appealed to the upper tribunal by the revenue, and the upper tribunal upheld that decision. And so it is now binding precedent, but they weren't saying that all livery businesses qualify. They were saying that where there's enough evidence that you're offering additional services like this, then it won't be regarded as holding an investment. So if you have any livery business type clients, that's a good case to be aware of. Yeah. Now, there's another situation as well as AIM type stocks where you get business property relief at 50%. And in fact, this one hasn't changed. It's where you've got land and buildings or plant and machinery that you personally own, and it's used either in a qualifying partnership where you are a partner, so that is a qualifying business for BPR purposes, or a qualifying company that you control, and you have to be controlling, not just a shareholder there. And that property gets 50% BPR, and that's always been the case. That's not a recent change. So what that means is if I'm a partner in a partnership with three of you, I'm the eldest and the senior partner. I personally own premises from which the partnership trades. If I drop dead, all things being equal, my partnership share is going to be eligible for 100% BPR up to 2.5 million and then 50% thereafter. And the property that I personally own that's being used by the partnership is going to attract 50% BPR. And also, I don't know if any of you have got clients who own a controlling interest in a quoted company. I've never met anyone who does. I think there are a few people out there because I think to be a fully quoted company, you only have to have 25% of your shares in circulation. But if you've got voting control of a quoted company, you get 50% relief. Otherwise, quoted companies don't get BPR. So obviously the normal thing is you don't get BPR on fully listed companies, but you can have 50% on AIM type stocks. Now, you also need to be aware of the accepted assets rules. Now, this is where you have a qualifying property. So you've passed that test that you haven't got more than 50% excluded activities. But within it, you've got some assets that are not really being used for your business. And that's covered in section 112. And it says that an asset is an accepted asset unless it satisfies at least one of two alternative tests. One is that it's been used wholly or mainly for purposes of the business concerned throughout the whole of the last 2 years of the relevant period. And the other one is that it's required at some time for future use. Now, the problem with this is obviously you may have some investment sitting in a company where it might clearly be a case, but they will apply this with large cash balances if they think you're just sitting on cash. Because it's a question of you've either got to be able to show that it's been being used in the business in the last 2 years or is required for future use. If you've been sitting on a load of cash, as long as you clearly are still a proper trading business, you'll qualify, but there will be a restriction. And the way it basically works is if you've say that it's determined you've got 30% accepted assets because you've got a large cash balance there that's sort of surplus to requirements, then only 70% of your share value will be eligible for business property relief. It's done proportionately like that. Now, it does mean that if you've been sitting on a lot of cash and you know that someone who's a shareholder is going to make a lifetime transfer soon, or unfortunately, you know they're going to die in the next few months, you could actually, use a lot of that cash in terms of renewing your plant and machinery or something, shortly before the person died, and that would be okay because it wouldn't be that it's not been used wholly for business purposes for the last 2 years. But that past use test is got to be the 2 years immediately preceding the transfer of value in question, or if you've owned this accepted asset for less than that period, for the whole of the period you've owned it. And if a trading company, as I said, they can use surplus cash to acquire assets that are going to be used for business purposes, even if the acquisition takes place shortly before the transfer, and it would get you outside the rules. But the more interesting bit is the future use test, because you're not an accepted asset, even if you've been not being used for the whole of the last 2 years, if there is likely future use of it. And there's an important case to be aware of, which is Barclays Trust case from getting on for 30 years ago now. And in it, the deceased held 50% of the shares in a company that carried on a long established bathroom and kitchen fittings trade. And when she died, the company held 450K in cash. And the revenue were happy that about 150K of it was sort of normal working capital being held for trading purposes. But they said the rest of it's just been sitting there for years, no use of it, and no likely future use. And why this case is quite important is what the special commissioner said in the judgment, which the revenue won the case, was that, in my opinion, required for future use implies some imperative that the money will fall to be used upon a given project or for some palpable business purpose, i.e., at the time the transfer happens, like the woman died, at that point, there has to be some clear, likely future use of it. And therefore, the normal advice that's ever since that case has been given to businesses like this, particularly with more elderly shareholders, if they are sitting on a lot of cash, is have regular discussions at your board meetings about what you might do with the cash. We're going to still keep this cash back because we might need to move to bigger premises, or we think we're probably going to have a big advertising campaign next year, so let's keep the cash back for that. Now, at least it gives you some sort of documentary evidence as an arguing point, with the revenue if they bring up this issue. Doesn't mean you'll win, but at least it's something you might be able to fight. But there does have to be some sort of palpable business purpose that the money's likely to be used for it not to be an accepted asset. Should also just mention actually that that 150K that they were happy with actually represented about a figure equal to about a quarter of the company's turnover. And so, in that case, obviously the revenue were happy with a figure of a quarter of turnover of being held for cash. Doesn't mean they would be again, but it might be a sort of ballpark figure to give you an idea. Now, the other thing you've got to be careful of if you're dealing with small companies or partnerships are the rules on a binding contract for sale. And that's where you've got relevant business property that otherwise qualifies. It says in section 113 that no BPR will be given if at the time of the transfer there is a binding contract for sale over the asset. And the typical example would be in a partnership, if you had a term saying if a partner dies, the other partners will buy out their share automatically at market value, or in a family company, the other shareholders will buy out the share at market value. It would mean no BPR will be given because there's a binding contract. Now, how you get round that is by giving the personal representatives of the deceased the option to sell at market value to the existing partners or shareholders, and giving the surviving partners and shareholders the option to buy. It's called a double option agreement. Either side obviously could enforce it, but there's not actually a binding sale at the date of death. And in a long-standing statement of practice, the revenue refer to this and say they're happy as long as it's properly drawn up, that would not negate you getting business property relief. So that's the type of agreement to have. Also mention that one of the situations you can have, you got someone who's got quite a valuable company, which would be eligible for BPR. You've arranged the sale of the company for them, and they go in and sign the contracts for it, which are going to complete in 3 weeks' time or something. And when they leave your office, they get hit by a bus and are killed unexpectedly. They've just lost all the BPR on their company because there's a binding contract for sale at the point they die, and you have to warn them of that if you're in a situation like that. That is a risk, and you can't do anything about it. Um, okay, I think what we'll do there is we'll take a very short break for just 5 minutes to let you stretch your legs. There's a little bit I just want to cover here. Then I think we'll get on to the pension stuff next, which is very important. Um, so I make it just after 1:15. I'm going to start again just after 20 past if you want to just stretch your legs quickly. Hey, ladies and gentlemen, short break. Just a reminder, we're going to run till about 10 past, and I'll get through as much as I can by then. And I will deal with any remaining questions at the end once we finish the lecture. Okay. So just finish off these little areas to do with BPR, limited liability partnerships, which some of your clients might have. If you've got an individual who's a member of a partnership or an LLP, an ordinary partnership or an LLP, and the partnership holds shares in an unlisted trading company, the partnership interest is only going to qualify for relief if the business of the partnership or LLP meets the relevant business property definition. And it won't, because it's holding an investment. It doesn't matter that it's a trading company, it's still holding an investment. And so your partnership share wouldn't qualify then. And you can contrast that with if instead of a partnership structure, you had a holding company that was owning a trading company or a trading group. The legislation is different, and the shareholders in the holding company, when it's the holding company of a trading group, they can still have business property relief. So that partnership structure, is not efficient if you are holding a subsidiary company like that. Different example, it's become quite popular over the years for property, real estate, to be held outside of the main trading company to protect the property from trading risk. If there's a downturn, a lot of people probably wish they'd done that sort of thing before COVID hit, and also to allow the owners to benefit from a single CGT charge on any onward sale. Because if the property is within the company and it's decided to sell it, there'll be a corporation tax charge within the company. And one way or another, eventually those post-tax profits you're going to want to get out of the company, whether it's liquidating the company, paying a dividend, whatever, and there'll be further tax charges on it. Whereas if you just own the property outside the company and it's sold, it's a one-off disposal. Now, if it were held directly by the owners, then as the asset was being used wholly or mainly for the purposes of a business carried on by a company which they control, they would get 50% business property relief, remember. But in order to mitigate the difficulties of owning land, often the owners decide to actually have an LLP to own the land, and they're members of the LLP. I mean, one of the issues is you can't have more than 4 legal owners of land and buildings in the UK. So if you've got multiple people going to own it, you have to have some sort of structure. And they have an LLP owning the land. On that basis, the asset which they own is an interest in the partnership. And when you assess the business of the partnership, it's going to be deemed to be holding investments because it's land that they're holding. And so you wouldn't get that BPR that you would get if you were owning it personally. And one final example, a partnership or an LLP is conducting a qualifying trade. So the partnership's actually trading. The partners are an individual and a company. So there's a corporate partner, you've got a mixed partnership. And the individual holds an interest in a trading partnership. So that would be eligible for BPR. What about the shareholders in the corporate partner? Well, if you assess the business of that company shares you've got, it's going to be that it has an interest in a trading business. It is a partner in a trading business, And on that basis, you should be able to get business property relief in a situation like that. Finally, retiring partners, family members, etc., retiring from partnerships. You should be careful not to retain capital in the partnership once you've left, because once you've retired, it will no longer be your business and there won't be any business property relief given. And the normal solution is not to retire, but to become a limited partner at that stage if you're not already. And that is enough to still mean that you're involved in the business and that potentially your capital can pass. Okay, I will be coming back to issues to do with family companies, but I want to cover the pension stuff next because it's quite a big chunk of time to cover this. Probably the most important current issue. And For those of you listening, even if you're not going to be advising on IHT, I suspect it'll be of personal interest to many of you. So the changes that are coming in from the 6th of April 2027. Well, the standard practice at the moment, if you're not aware of it, if you've got enough money, is to build up a big pension fund and write the death benefit from it into trust for your family members via an expression of wishes, as it's normally called, and then try and live off your other assets. And when you die, under the current law, that pension fund comes outside your estate. Now that is changing, and the rationale for it. I'm not trying. You can have your own views on the politics, economics of it. The reason it's changing, and it's sort of thing that a lot of people have felt is not right over many decades, is we do give in this country a lot of tax relief for private pension schemes. You can have top rate tax relief still, tax exempt growth in the fund, etc. And the whole idea of that was originally so that people could work hard and save and have a lot of income to live off in retirement and enjoy a long retirement, hopefully. Not so you could leave a tax exempt amount to your kids. And really, what they're doing is clamping down on that sort of thing. You can have your own views on it. I'm just explaining the rationale for it. Now, under the current rules, as I've said, those death benefits would be outside the estate. And in practice, the scheme trustees are going to distribute the assets, normally in the way that you've suggested in your nomination form. Now, the big change ahead, which was announced on the first budget of this government, but there's a sort of 2.5 year window for it comes in. So we've still got time to plan for it before next April, has now been legislated in Finance Act 2026. And what it says is that certain pension interests are going to be treated as part of the deceased estate for IHT purposes. And that's registered pension schemes, qualifying non-UK pension schemes, and there's also something called a Section 6153 scheme, which you probably won't come across. Those are a particular type of occupational scheme. I don't think they get established these days, but people might still have use of them where employees were working wholly or partly abroad. Excuse me. And what the legislation is doing is saying that all of those, if you've got those when you die, it's going to be regarded as notional pension property of you at death. Because to charge IHT, it's got to be on stuff that you had when you died effectively. So that's what they're doing. Now, before I come back to the inheritance tax, you need to understand the interaction with the income tax rules. And these have changed a few times in recent years, so I wouldn't blame you if you're not quite fully up to speed on it. Under the existing income tax rules, if the deceased was age 75 or over when they died and they leave a undrawn pension fund, any benefits that are drawn down by a beneficiary are fully taxable at the recipient's marginal income tax rate. If the deceased was age 75 or under, it's only benefits drawn in excess of something called the death benefit lump sum allowance that are taxable at the beneficiary's marginal rate. And that's a new term was introduced about 3 years ago. So again, I wouldn't be surprised if some of you are not familiar with it if you don't deal much with pensions. Now, the death benefit lump sum allowance caps the aggregate that can be taken free of income tax during the individual's lifetime and on death. So if you have previously taken a tax-free lump sum from your scheme, as many people will have done, that will restrict the amount of death benefit lump sum allowance that there is for whoever's receiving income after you've died. Um, and the DBLSA is set at 1.073, 1,073,100, which many of you may remember as being the value of the lifetime allowance before it got abolished 2 or 3 years ago. It's still that figure. And you may remember that when they cut the lifetime allowance at different stages, you were able to apply for various protections to have a higher, keep a higher value of lifetime allowance. If you've got any of those protections, that's reflected in the DBLSA as well. That will be higher. Now, there are no planned changes to the income tax rules, apart from one point that I will mention at the end when we've dealt with the inheritance tax. So I've given it an outline, just very quickly run through my slides to add a bit more into this business about what the standard planning was before the announcement, is that non-pension assets would typically be left to the surviving spouse, either outright or by way of a qualifying interest in possession. Either of those, remember, would be exempt in your estate. The surviving spouse would then review their own needs, and to the extent they could afford to, they could pass on assets to children, as soon as possible, hoping to survive 7 years and get them exempt inheritance tax. Or if they survive 7 years and the gifts are above the nil rate band, at least get a reduction in the. If they survive 3 years, at least get a reduction in the tax bill. And the second spouse's estate will ideally benefit from two nil rate bands and two residence nil rate bands, assuming you're meeting the conditions about leaving a home to a direct descendant, etc. Now, while alive, the couple transfers any excess income. While the two of them are alive, they tend to try and build up big pension funds as best they can, without incurring any annual allowance charge by exceeding the 60,000 limit. And obviously they're getting benefit of pension tax relief on that. And where the individual as well as the surviving spouse can fund their retirement from other assets, the pension pots can be left untouched, and then when they die, they were going tax free, to their children or whoever they've nominated them for. And often, obviously, those kids would, when start using those assets, would be paying a lower rate of tax. Now, no IHT is payable on the distributions from the pension pots at the moment, and any payments, though, are going to be subject to income tax at the beneficiary's marginal rate if the deceased was age 75 or over, or completely free of tax up to the available death benefit lump sum allowance if the member died before their 75th birthday, and taxable thereafter. And obviously, if you're leaving amounts to children, grandchildren, they may have lower rates of tax. So it aims to minimise tax on the first death by having it as an interspousal transfer, provide maximum flexibility to reduce IHT on the second death. Now, what schemes are affected by the changes? There has been a bit of toing and froing with this, since the first announcement and as the finance bill has gone through. First of all, repeating the bit I said earlier, that a registered pension scheme, a qualifying non-UK pension scheme, or one of these 6153 schemes is going to be treated if there's any, undrawn amount, whether you have never used the scheme, or whether you've taken lump sum out of it and maybe some drawdown, but you've got unused drawdown funds. Any of that comes within this, and that's going to come into the estate. And the changes are also going to apply to what are referred to as secondary pension benefits, so that if I died and you're my child, say, and you've inherited my pension rights and you've been drawing down on it, and you unfortunately die in a few years' time and there's some undrawn amounts from it, then those will come into your estate on your death. Now, if a member purchases a guaranteed or value protected annuity, normally when you buy an annuity, it gives you a guaranteed amount of income for the rest of your days, and then there's no value when you die, so nothing will come into your estate. But you can buy ones that have a guaranteed payout period, or so the capital amount protected in some way to make sure a minimum amount is eventually going to be paid to you. anything like that, if you've got an annuity in payment, the death benefit of any sort of capital guarantee or protected amount that's still to run would be included, unless it's covered by the spousal exemption. And it's worth emphasising that point at the moment, although it'll come up in the example that um, if I die and I've got a big unused pension fund, but if I'm leaving everything to my spouse, including the pension rights, then it's covered by the normal exemption. Or indeed, if I specifically leave my unused pension fund to my spouse, it's covered by the exemption. Death in service payments made under defined benefit schemes like final salary schemes are not going to be caught. That was quite a late change in the finance bill. So what it means is that if a widowed or divorced father, for example, dies and there's a death in service benefit equal to 4 times salary paid out of the direct defined benefit contribution scheme for the benefit of his minor children, that will not be subject to IHT. Originally it was going to be, but it's not going to be. Just to emphasize, this is a change for pension policies where they're paying out on death. No change generally to life assurance rules. They don't come into your estate. You can still write life policies into trust and it'll be outside the estate. So no problem with that. Joint life annuities, of which there are many, they remain excluded from IHT when the first death occurs because the annuity is going to continue in payment. But if the joint annuity provides it, for example, for a 5-year guarantee or value protected lump sum, then these can form part of the estate, as we've already said. Now, one of the things that's going to happen is that the estate admin is going to become a lot more complicated. And I'll take you through that now, and then we'll do an example with some numbers. So the initial proposal was that pension scheme administrators would be responsible for reporting the value of the pension pot to the revenue and then paying any IHT arising on it, which I always thought was crazy because obviously the executors deal with the estate. And it's only when you know what the estate is saying, what other assets there are, whether there are exempt transfers and things like that, that you actually know what the overall liability on the estate is going to be. So they binned that idea fairly quickly. And the pension scheme administrator's responsibility is now going to be limited as follows. First of all, they'll inform the deceased personal representatives of the value of the death benefits for IHT purposes. And they've got to do that within 4 weeks of receiving notification of the member's death. The pension scheme administrators, based on the information provided by the personal representatives about the surviving potential beneficiaries, will then let the personal representatives know how they have determined to distribute any death benefits, usually in line with the expression of wishes. And that's going to include reporting how the pension funds are going to be split between exempt and non-exempt beneficiaries. They've got to tell the personal representatives that, so the personal representatives can calculate the tax charge and allocate it amongst the parts of the estate, as I'll show you. And then the pension scheme administrators, if necessary, they will settle the IHT due on the pension funds, either direct to the revenue or by repaying the personal representatives. If the personal representatives have already settled that on their behalf, which they might do as part of the probate process. If you're a recipient under a will and including of pension rights, you can agree to settle up the IHT yourself if you have the funds, so the whole amount can just be released to you. But there's a reason you might want to do that, as I'll mention at the end of this session. And finally, the pension scheme representatives will liaise with non-exempt beneficiaries to explain that IHT may be payable on payments due to them from the pension, which obviously previously they might not have been expecting. Now, the personal representatives can now issue a withholding notice to the pension scheme administrators that requires them to keep back the deceased pension funds up to a maximum of 50% of what the IHT tax charge is for up to 15 months, so that all the pension rights are not paid out when in fact there's IHT to pay on it. They can also direct the pension scheme administrators to make a direct payment to the revenue of the tax bill. Now, we mentioned earlier nil rate band wills in trust, sorry, trusts in wills, and they're very common. And I suspect many of you listening, if you can remember what's in your will have one in there, and you're probably going to have to get your will rewritten if you've also got pension funds, because typically how the documentation, the will itself, sorry, will say that a nil rate ban is being set up. They'll say that you're going to put into trust an amount equal to the prevailing nil rate band at the date of death, less any chargeable transfers made by the deceased in the 7 years before death, because that's obviously restricting the nil band, less the value of any property in which the deceased has a reservation of benefit. This is where they have gift legal title of something, but they've retained rights to use it, and it's treated as still part of their estate. So that would again be using up nil rate band, and you need to make sure that was accounted for. What you won't find any reference to is amounts that are due on pension scheme rights. And because there could now be some nil rate band being used against pension scheme assets, that would actually restrict the amount you can put in without triggering a tax charge by being above your prevailing nil rate band. And it's not going to be documented in the will. So you're probably going to have to rewrite it. And it would mean more than, it could mean more than the available nil rate band actually passing into the trust. Not only will that trigger tax charges going in, as we discussed earlier, but in fact, long term, when you come to look at exit charges and 10-year charges, that's bad news as well, because there's a knock on effect. So now the interaction with the income tax rules, there's been, apart from one point I mentioned at the end, there's been no change to the income tax rules. So coupled with the IHT changes, it can lead to a very high effective tax rate on unused pension rights at death. And I'll do an example to show you. And this is deliberately a kind of, almost worst case scenario for you. And it won't always be this bad, but Louisa's a widow. She's aged 81 in June 2027. She leaves a house worth 900,000 and other assets worth 1.1, I should say 1.1 million there, sorry, 1.1 million to her only son. So her other assets are worth 2 million. Now, what we can say so far is that because she dies after the 5th of April next year, any unused pension rights would be coming into her estate. And because she's dying age 75 or more, any amounts drawn down by beneficiaries are going to be fully taxable. There won't be any death benefit lump sum allowance available. When her husband died, he'd left everything, including a half share of the house, to her. Louisa also had an undrawn defined contribution pension worth 800,000. And her nominated beneficiary is her son, who is a top rate taxpayer, done very well for himself. Now, under the proposed changes, I should change that really to legislated changes. It's possible, obviously, they could make some tweaks before it all comes in, but it has now been legislated. A chargeable estate will include the pension rights, so it's going to total 2.8 million. And that means no residence nil rate band will be available, because it gets fully tapered away when you've got a double nil rate band, when your estate goes above 2.7 million. So just a reminder, the residence nil rate band gets tapered away when the value of your estate before reliefs and exemptions goes above 2 million. And when you've got a double nil rate and double residence nil rate band available, that's 350k. And so it's when you reach 2.7 million of estate that will be fully tapered away. And at 2.8 million, that's going to happen. So the IHT liability on her estate is going to be 2 lots of nil rate band, 650k at nil, and the other 2.15 million at 40%, which is 860,000. Now, the average estate rate You get that by dividing the total tax charge by the total estate, is 30.7143%. And that's going to be used to split the IHT proportionately between the personal representatives of the free estate assets and the pension scheme administrators, the 800,000 pension fund. That would give 245,714. So that's how the amounts will be split up. Now, if we take it further, supposing she actually died in the next few months before the changes come in, her estate would not include the pension fund. So her estate would be 2 million. And one of the consequences of that is she'd have the benefit of two residence nil rate bands. And if you were to calculate the liability on her estate in that situation, she's got £1 million of assets, excluding the pension fund, is at nil. And the balance, the other million, would be at 40%, giving you 400,000. So, in fact, what this change has done for her is it's increased her inheritance tax by 460,000, the difference between what it would have been before the changes and what it is afterwards. And that's a lot of that is due to the loss of the residence nil rate bands because it's put her estate so high. And her son's a top rate taxpayer. So when he draws down the residual income from the pension fund after the inheritance tax charge, he's taxable at 45%. And that is another almost 250k of tax. So that the actual total amount of tax that's going to be hit this £800 pension fund in the end is going to be 709,000, and you've got an effective tax rate of 88.68%. And in fact, had I changed my numbers slightly so that it was 700,000 a pension fund, it would have been 91.33%. So you can see potentially very high charges. And I've given you a worst case scenario here. The woman is over 75, so you don't get any death benefit lump sum allowance, to have some tax-free drawdowns for the beneficiary. The person making the drawdowns is a top rate taxpayer, whereas obviously it might only be a basic rate taxpayer. And with different numbers, if the rest of her estate was only 1.2 million, adding in the pension fund wouldn't have affected the residence nil rate bands at all, and the IHT would have been a lot lower still. But it shows you how bad it can be. Now, in the finance bill, they did play around a bit with talking about giving credit for income tax where on the drawdowns where IHT has been paid. And in fact, the position seems to be now that if the person died under 75, and let's say the pension fund is £1,000 and the IHT on it is £400, let's say, that would leave £600 left. When that gets paid out, there's a deduction from the £600 pension income for the £400 IHT paid. So only the balance of £200 would actually be charged to income tax. Now, I emphasise this is if the person died under the age of 75. So, for instance, that would actually give, on drawing down the £600, there'd only be a 20% charge for a basic rate taxpayer on 200 quid, which would give an overall tax charge of 44%, including the IHT. And equivalent figures, if it's a higher rate or top rate taxpayer, would be like that. But there is no credit given if the individual themselves have settled the IHT, which, remember, is an option. So you don't want to do that in this situation. You'd end up having paid the IHT and then still having the full drawdown that you could make, but being taxed fully on it. And it would be back to those very high tax rates. But if the person died age 75 or more, there is no credit given for the IHT. Like in my example when I was doing the drawdown. So, very complicated rules. Now then, just to round off this area, because I want to make sure I talk about some other issues as well. Generally, IHT planning going forward is going to depend on a number of specific factors. So it's very much going to be targeted towards the individual's position, how much their pension rights are, how old they are, who's going to be taking the pension, in the end, and that sort of thing. But some particular ideas would be there doesn't seem to be any disadvantage now to actually drawing tax-free cash from your pension scheme. And if you don't really need it, gifting it onto your beneficiaries and hoping to survive 7 years if you've got enough other assets to live off. And you probably don't want to just leave your pensions your pension scheme undrawn like historically we have. Probably better to draw down additional income, pay the income tax on it when you draw it down, and then perhaps if you don't really need that income, make use of the regular gifts out of income exemption that I talked through quite early on in the session, to gift the post-tax income onto your kids. And particularly if you're paying income tax at a rate less than 40%, that'll be cheaper than having that in your estate and being hit for IHT. Review arrangements to see if you want to have an expression of wishes in favour of a spouse now for your pension, and you might well want to do so to make sure there'll be an exempt transfer on it. And you can make provision for any IHT that might be arising by effecting a life policy in trust for the beneficiaries who might now suffer it. But that's always subject to normal insurance risk of cost relative to what your life expectancy is. And finally, review the wording of wills that include a nil rate band discretionary trust for the reasons that I said. Okay, going to leave that area behind, but obviously it's a really key one at the moment. And for the last 20 minutes or so, I want to get on and talk more about gifts to family members and also to trusts. We'll bring in a little bit of CGT here as well. So, some of you may know the basics of some of these things, but I'm going to cover plenty of points that I think many of you will not be aware of. First of all, if you're making a gift, obviously it needs to be valued, and you can submit a form CG34, which is called a post-transaction valuation check for capital gains, in order to agree a valuation. Now, you want to do that if you're gifting land and buildings or unquoted shares or something where you need to establish a valuation, do it as soon after the gift as possible. You can't do it beforehand. It is a post-valuation check. But if you put it in and they review it and they don't come up with any queries on it, as long as you have given accurate information, then you should be happy using those figures when you submit a self-assessment return dealing with the gift for capital gains purposes. And the revenue, you might then end up in negotiation with them, and it turns out the figures have to be amended a bit. But you should avoid any penalties for putting wrong figures in, as long as they're happy that you were making a genuine effort to get it right. The revenue do regularly challenge valuations, so make sure clients are aware of the extra sort of time and fees that process might involve. Now, holdover relief for capital gains tax, or gift relief, that many of you will be familiar with. In the legislation, there are basically two types. The Section 165 relief, which is for what are called business assets, and it lists specific things that you can claim gift relief on if you're gifting, say, to a family member, including unlisted trading company shares, assets used in an unincorporated trade, land that's eligible for agricultural property relief for inheritance tax, that sort of stuff. And that's probably the type of gift relief, if you deal with CGT, that you're more familiar with. It doesn't cover things like land and buildings. It doesn't cover quoted shares, for example, other than in a very minor situation where it's available for quoted shares. You are likely to be less familiar with Section 260 unless you're a trust expert. What Section 260 says is that you can have gift relief on any asset if the transfer is going to be immediately chargeable to inheritance tax. Okay, that's to avoid an immediate charge to both taxes. Now, when we talked about trusts, we said that if you put gifts into a relevant property trust, which, remember, these days is any discretionary trust or any lifetime interest in possession, unless it's for a disabled person, it's chargeable going in. There may not be any actual tax liability if it's covered by nil band, but it's chargeable. And similarly, we talked about distributions out of such trusts suffer an exit charge, relatively small rates, and it can indeed be nil. But if it's chargeable to an exit charge, then it means you'll be able to have Section 260 relief going out. So the use of that section for gift relief enables you to defer gains going into trust and defer them coming out of trust, normally. And the effect of a gift relief claim, if you've not dealt with it or haven't done for a while, remember, is that there's no tax chargeable on the donor, but the recipient effectively takes over the donor's CGT cost, so that when they eventually dispose of the asset, the gain or loss that arises will reflect the combined ownership period. Now, I've got a bit more detail on qualifying assets here, which I probably don't. I'm going to save a bit of time. I probably don't need to really go into that now for you. It's there. You can, refer back to if you want to. Now, if the transferor is making a disposal of family trading company shares, then business asset disposal relief would be available on the gift as long as the normal qualifying conditions for BADR are met. That you're an officer or an employee of the company, minimum 5% ownership, owned the shares for 2 years, etc. And that would give you an 18% tax rate on any gain up to £1 million. But that's still a lot of tax, isn't it? And you probably don't want to make a gift for IHT planning purposes if it's going to trigger a sizable liability for you. And that CGT can be emitted via a joint gift relief claim with the recipient. And the effect is that no tax will be payable by the donor. The transferee will take over the recipient's cost. However, if you're not aware of it already, be clear that the benefit of any BADR for the transferor is completely lost. That doesn't pass across to the transferee at all. Whether or not they get business property relief, I'll come back what's on the slide there, but whether or not they get business property relief if they subsequently make a disposal will depend on their own qualifying conditions. Have they owned the shares for 2 years? Do they work for the company, etc.? Is it still a qualifying company? And that will apply whether a gift relief claim was made or not on the original transfer. Let's do a quick example, very basic one. Heather has built up an unquoted trading company that's now very valuable. She's aged 58 and has decided to make lifetime gifts of a 15% stake to her son who works for the company, a 15% stake to a daughter, a son who doesn't work for the company, 15% to a daughter who does, and a 3% stake to a grandson who works for the company. Gift relief claims get made, which would be fine. There's no, condition that you have to work for the company for gift relief, and there's no minimum holding at all for unquoted shares. Supposing 3 years later, an offer comes in that's too good to refuse and that all the shares get sold, all things being equal, the gains that her son and grandson make will not qualify for BADR. And that's because the son doesn't work for the company and the grandson owns less than a 5% holding. And worse still would be if an offer too good to refuse came in after 18 months. Heather would still be okay, but the daughter wouldn't get BADR either because she would fail the minimum 2-year ownership period. So if you're, advising on making lifetime gifts like this and claiming gift relief, you need to warn, people of this sort of situation occurring. If suddenly your plans change, be aware it could actually leave you in a worse position overall. Now, from a planning perspective, to maximize BADR, and I should say that now that the business asset disposal relief rate is now 18%, it was 14% last year, it's 18%. It's only on £1 million of gains. The main CGT rate is 24%. You only get a 6% saving, which is 60 grand these days. Obviously, still very worth having. But compared to a few years ago when it could have saved you £1 million, BADR has become a lot less valuable, but you still want to get it right. And to maximise BADR on subsequent disposals by family members, it's best to try and give holdings of at least 5% of the ordinary share capital, votes, etc., to those family members who are officers or employees of the company. And if you appoint someone as a company secretary, that's enough because it makes them an officer of the company. So that would be all right. And then, 2 years later, they would qualify. Now, you have to consider when you're thinking about making transfers whether a death transfer would be better or not. And the usual planning from an IHT perspective is to give assets away well in advance of death. But family company shares showing a large gain may be better being transferred on death, because it'll wipe out the gain entirely. If you transfer it on death, you get the tax-free uplift, as we call it. No CGT is chargeable on the death. And the beneficiary takes over at probate value. Now, that's better than a gift relief claim where you can avoid tax, but remember, whoever's receiving the gift is taking over the original cost. So it's really just a deferral rather than an exemption. And if business property relief is available on the death, 100% of the first 2.5 million of value will be effectively exempt from inheritance tax as well, with 50% thereafter. So if you've got family company shares that the person owns and they're only, they're qualifying for BPR, and they're only worth 1.6 million, then that's going to get 100% IHT relief on death, plus it's going to get the CGT exemption, which is much better. Very quick little case study I'll take you through. A client's in his mid-50s and in good health, looking to gift a holding of family property company shares, cost 300,000, value 300,000, cost 120,000 to his daughter with a view to mitigating eventual inheritance tax. Now, these are family property company. It's a rental type business, so there won't be any BPR available. There won't be any gift relief available. There won't be any BADR available. He's made no lifetime gifts and will say he's a high rate taxpayer. Will consider the relative attractions of an outright gift or setting up a discretionary trust to hold the shares for the daughter. Now, if we look first of all at an outright gift, we know that will be a potentially exempt transfer for inheritance tax purposes. No IHT if he survives 7 years, and it obviously wouldn't then be using up his nil rate band. We do always have to consider, what would happen if he did die within 7 years, that it would become chargeable. But, the immediate gift, it says he's got good life expectancy. There won't be any IHT, but he's got a capital gains tax problem because he's got a capital gain of 180K, and there's no, no way of deferring that at all. And therefore, the CGT liability on it at the current CGT rates after taking off his annual exemption would be 42,000 odd. So someone's not likely to want to make a gift and pay up 42 grand in the hope of this 300,000 of value falling out of his estate within the next 7 years. If instead he makes a gift to a trust, that'll be chargeable to inheritance tax because it's a chargeable transfer, lifetime trust. But the 300,000 value is covered by the nil rate band, and so there won't be any charge going in. Gift relief is then available under Section 260, so that a significant CGT charge can be avoided by the donor. And you've managed to get these assets into trust for your daughter without triggering any tax charges. And those are now in trust. And if they get appointed out of trust at a later date, there will be potentially an exit charge, which is these small tax charges going out. But if it's done in the next few years, because of the way the rules work, in fact, there wouldn't be any. I haven't gone into that sort of detail today, but it will be chargeable to an exit charge. So you could have gift relief coming out again to the daughter in the future. And so you'd end up with her owning the shares without any tax charges, but having the original cost of the donor or the father. And you obviously can't, or not, maybe not obviously, but you can't sort of set up the trust today, put the shares in, and tomorrow the trustees wind up the trust and appoint them out to her, because the revenue would easily do you under general anti-avoidance law about having a preordained series of transactions where you know what the outcome is going to be and you've inserted one just for the avoidance of tax. But if you leave the shares in there a while, and most advisors would always say a minimum of a year, then it's very difficult for the revenue to challenge it. And so that can obviously be a way of getting assets into the next generation without hitting immediate tax charges. And I just want to cover as well a couple of other things quickly if I can. Never a nice topic dealing with inheritance tax if you know recently had a bereavement or you know someone who's very ill, but unfortunately we have to talk about death a lot. And I'm going to talk about sudden, unexpected short-term life expectancy where you have family company shares that would be eligible for BPR. What sort of planning can you do? So someone finds, unfortunately, just suddenly that not being feeling very well recently, go to the doctor, ends up they've got a maximum of 6 months to live. They haven't particularly done the IHT planning. They've got a lot of family company shares that are eligible for BPR. One of the things you can consider is a dividend waiver, which may sound a pretty weird thing because you normally think of that in terms of income tax planning. But if the situation is that normally in the next month there's normally an annual dividend paid to him of say 200,000, what he could do is waive his right to the dividend. If he receives the dividend, that cash is going to be his and he's going to die shortly afterwards. So even if he gave it away, it would get caught for inheritance tax. But if he waived his right to dividend, he wouldn't have that cash and it would be reflected in a higher value of his shares and be more money in the company. And as long as you're not falling into accepted assets issues by having too much cash in the company, that extra value that would be maintained in his shares is going to be eligible for business property relief. So you're switching sort of cash for a bit of a higher value in shares, which hopefully will be eligible for 100% or at least 50% BPR. So that's a strategy that you can consider. Even more surprising for you might be the idea in that situation of making a rights issue shortly before someone dies. How does that work? Well, you you've got, you subscribe for shares in a rights issue that the company makes. Now, you might be thinking, you told us earlier that normally there's a minimum holding period for BPR of 2 years. So if you're subscribing now and you're dying in a couple of months' time, that wouldn't work, which is right on what I've said so far. But in the inheritance tax legislation, when it talks about ownership of shares, it refers through to the capital gains legislation and says the same rules apply. And some of you may remember rights issues are deemed to take place on the date that the original shares were acquired for CGT purposes, and that flows through to inheritance tax. So as long as your existing shares qualify, you've owned them long enough, your rights shares can qualify as well. And if you think that's too good to be true, there's a case about 20 years ago, Vinton and another, where the lady was a shareholder in Wilton Antiques, and she also had an outstanding loan. Just before her death, and in fact, it was 2 days before her death, the loan was converted to shares via a rights issue and some other acquisitions of shares, including buying up renounced rights of other people who didn't want to take up the rights issue. The executors claimed business property relief on the rights shares, and it was held that the BPR was available on those for the reasons I said, but not on the other acquisitions that she made, including via buying up other people's renounced rights, because the matching rules didn't work in the same way. But you can do that. And in fact, discussing that a few years ago in a class with a group, someone came up to me at the end and said they'd done exactly that sort of thing, a year or so earlier, and it saved the family a lot of inheritance tax. So potentially got a lot of savings by doing things like that. Switching cash into qualifying shares could save you, 80 grand of inheritance tax. Anyway, folks, we're about at the end here. I knew I wouldn't get through everything. I would have the next bit. If you read through it, it should be reasonably easy to follow. And then I've also got the bits on nothing to do with inheritance tax, PPR relief on sale and on a divorce or separation, where the rules changed, and then the appendix at the back for agricultural stuff. So I'm going to formally stop the lecture there, but I will just take a short time to review some other questions, and if there are ones I can answer quickly, I will do. But I hope you've enjoyed it and found it useful. Someone said, please show the formula again. I think that must be when I was talking about if you're trying to work out the tax from the net figure, you always multiply it by the tax rate. You multiply the net figure by the tax rate times the tax rate over 100 minus the tax rate. I won't go back to it, but I'll say it again. Multiply the net figure by the tax rate over 100 minus the tax rate, and that will get you to the figure. It is in the slides, and you've got access to the slide pack anyway, so you can go back to it. See if I can pick up any others quickly. Yeah, there's a point someone's made which is correct. If you go back to what we talked about earlier about net transfers and gross transfers when we were looking at chargeable lifetime transfers, and remember, if the donor pays the tax, the gross transfer includes the tax. It is correct to say that if you don't survive 7 years, it does mean that the tax is calculated on a bigger figure than it would be if it was a net transfer, because it's a different growth. Sorry, say that again. Didn't say that quite right. It does mean in that situation that if the donors paid the tax, the gross figure is actually higher than when the trustees paid the tax. And if they don't survive 7 years, it does mean a bit of a higher figure is going to be taxed to death tax. That is correct. It's an effect of the rules. Discretionary trusts, yes, these 10-year charges, it's every 10th anniversary. The question was, is there a subsequent charge after 10 years? Yes, it's every 10th anniversary or whenever capital is distributed from the trust, you have exit charges. It says, do benefits such as PIP and carers allowance count as income for surplus income exemption? I can't imagine people who are receiving those are going to be passing them on because they don't need them. I mean, I think is the answer to that. Um, a gift with reservation of benefit does still exist. Someone has asked, if a parent gives a house to a child and still lives in it but pays no rent to the children, what happens? In that case, the house will be in their estate when they die. You've gifted legal title, but you've retained rights to it. The only way you can do that sort of thing, continue living in it, is if you pay a market rent for continuing to live in it, in which case you haven't retained any benefit. Um, the question again about the exit charges, about what the 6% relates to. When I said it's the sorry about the 10-year charges, what the 6% relates to, it's a deemed disposal of all the capital in the trust at that point. But there's adjustments if there've been exits made in the previous 10 years. But it's a deemed disposal of capital, so it's based on the current market value of the assets, effectively. Uh, there's a question: if two parents put the home or other assets into a trust, does the trust have two nil rate bands for both chargeable lifetime transfer purposes and for future charge purposes? Basically, yes. The settlor's nil rate band is only relevant in terms of calculating their own tax, but how much nil rate band was available to the settlor does have an impact on the trust when you're determining what nil rate band they will have. But it is a distinct nil rate band. So there will be a nil rate band available for the trust. But it gets a bit complicated, which is why I've not gone into those details. Um, I think the issue about as a question about if a wife dies and the husband remarries but gets divorced, is he entitled to any of the unused tax-free allowance? I presume you mean the nil rate band of the first wife when he dies. Yes, it would be a former deceased spouse. what happens to residence nil rate band if someone goes into a care home for say a year before their death? If you mean by that that they no longer have a residence at that point, that's what the downsizing provisions are there to try and give it equivalent protection, which I touched on briefly. How many more of these we've got? I'll do another one or two. I'm sorry if I don't get onto yours, but obviously we need to finish. The question: okay, if on a husband's death they'd made a 125k gift to children 6 months earlier, so the total available nil rate band on so I think, and then everything I presume you're saying is being left to the spouse. That would be 200,000 of unused nil rate band then, because 125,000 has been used on the gift to the children. And when the wife dies, her nil rate band would get a percentage uplift based on whatever 200k out of 325k is. But if the nil rate band is unchanged like it has been for years, it would just be the 200k would transfer across. The question about whether the to transfer a residence nil rate band across the original spouse has to have been a co-owner of the property. No, it just means there has been an unused residence nil rate band, so it'd be available. I'm just going to do this very last one, and then I'm going to stop. It says most GP practices in the UK operate as partnerships. The surgery premises are often owned by the partners personally and reflected within the partnership accounts. The NHS paying notional rent to the practice. Okay. Given that the properties are used for the purposes of the GP practice trade, would they still only qualify for 50% business property relief? If they are personally owned, yes, is the answer. If they're not actually owned, if they're not a partnership asset, if they're part of the partnership assets when you die, then it will be 100%, up to 2.5 million. But if it's something you personally own that's used in a partnership where you're a partner, it would be 50%. But you seem to be saying it's not really personally owned, it's owned by the partnership. I haven't dealt with the NHS stuff like that, so I don't want to say anything definite on it, if that's okay. And at that point, I think it's the first one I haven't been able to give a definite answer on, which is better than normal. But thank you for listening. I hope you've found it useful, and do enjoy the rest of the day, and hopefully speak to you again at some point where you can actually see me. And I will see you soon. Cheers. Thanks.